Sijawahi.
Okay, testing, testing. Good morning, ladies and gentlemen.
Good morning, Council.
Morning, Council.
Good
I
morning.
hope you can see my screen and I hope you can hear me.
Sir.
Can you see my screen?
Yes, sir.
Okay, great.
We can see you.
So
We
I
can hear
thought
you.
the delaying would actually have people get out of the comfort of their beds. Definitely, it is 17 minutes past the time we had agreed to start. But I'm also aware that people have their beds before 8. It's very hard to get out. I see about 60 online, and I think that this is a good number for starters. I will introduce myself in the spirit of buying in some little time, and then we'll have the session started. I intend to run this session up to 1 because I am going to tackle areas that I feel every student must know. And that because your exam is very near, my assumption is that you will be still remembering what I am going to tell you today. So I called this a pro bono session because I usually do it every end of the training to ensure that I push out things that have not been clear to so many students, but also expand my gifts to my fellow professionals. I know that you guys are going to be the next professionals, and we have a role and an obligation to ensure that we promote this profession to where we need it. So it is intended to serve the purpose of giving back to my professional society. And of course, to mentor you as professionals, that when you also qualify, don't only focus on money, but also focus on developing those around you. I see the rate of those joining online is high, and I'm expecting that as you join in, you mute your microphone. So ladies and gentlemen, especially those that have not been in my classes, my name is Council CPA Julius Nandeva, and I have a simple profile which I will just highlight in the few minutes as we wait for those who are joining in, because I think when the online guys reach 80, we should be able to start. They are now 75. So I will briefly, in the few minutes, talk about myself, and so that you understand the person you're dealing with, and then I will tell you what we are going to cover today. And I will give you an opportunity to ask anything in taxation that you feel you have revised and you have not appreciated. But that is going to come at the end of the session. And the reason is we want to make sure that we keep in the time.
Is the only person I started with that.
Please mute your microphone when you enter class. Kindly mute your microphone when you enter class, because we have so many people entering in. And the administrator should be able to mute those who enter in so that we control the class. The number is going to be big, so let's control the numbers and the noise in the background. So ladies and gentlemen, my humble background is that I'm an advocate of the High Court, and I hold a Bachelor of Laws from Makerere University, and a diploma in the legal practice from the Lord Government Center. That makes me a lawyer, but prior to becoming a lawyer, I was also in your profession, and I'm still in your profession. I am a member of the Association of Chartered Certified Accountants of UK and a member of the Institute of Certified Public Accountants of Uganda. Just like most of you, I also hold a first-class honors bachelor's degree in accounting, also from Makerere University, and a postgraduate diploma in tax and revenue administration of Uganda Revenue Authority. I have definitely had a number of trainings, international and local trainings, spanning into international taxation, transfer pricing, double taxation treaties, tax compliance, value for money audits, etc., etc., including studying tax administration of other jurisdictions. I currently work with Uganda Revenue Authority as a manager in the Medium Taxpayers Office, and I have been doing that for at least 14 years in the Revenue Authority. And I have tried to mentor and train tax professionals and accounting professionals. And definitely at Capital College, I am a director at Capital College, and I love tutoring. I think tutoring is one of the things that I do as a passion. So I love tutoring taxation, advanced taxation, financial reporting, and advanced financial reporting. That is just the brief about me. And now this ushers us into the main reason why we are here today. I am happy that after that brief that was intended to give those who are late some time to join in, I now have the minimum that I needed, because we said once we hit 80 online, we should be able to start. We are now 83 online, and we also have participants here in the physical class at Capital College, Bat Valley, and therefore I am glad that we are all ready to start. The intention of this session is definitely for the exam. So I'm not going to be teaching, but I'm going to be highlighting areas that you must put in your head, so that when you get into the exam, at least you know that this one, Julius emphasized it, I must do it for me to be able to pass. Taxation is one of the areas that you should be able to pass with ease. So I am going to basically talk about these areas that I'm calling the focus areas. I am going to emphasize your number one. Your number one is going to be on business income. In other words, computing tax payable or tax liability of a person. And when I talk about a person, it can be a company or it can be an individual who is going to be in business. So get ready, because that is where your biggest marks are going to be. We will also talk about employment income. We'll talk about VAT. We'll talk about customs. We'll talk about partnerships. And we'll also talk about rental income. And then we'll give each other a chance to ask any questions, and we'll be able to answer those questions. And in case there are any areas that are not incorporated in here, please do not think that they will not come, because some students will say, now that Julius has not talked about this, it will not come. No. I am only picking the common areas that every student must at least be aware of. So that said, I want us to get into the gist of the discussion, and I will take it slow on you, but at least have enough speed that will cover the areas that we have purpose to cover. So I am going to share. I have always shared my summary Excel sheets, but I'm sure that many have not mastered it. I want to help you to master it so that you understand when they ask you any question on income tax, business income, what is expected of you. So we are going to be discussing the answers. We are going to be discussing the answers. Sorry, let me see. Okay, I hope my screen is visible. So I'm going to start, like I said, I am going to start with your number one. And please pay attention on your number one. I am going to tell you what the examiner is going to give you and what you expected to do. In your number one, like we said, the examiner is going to ask you to compute the tax liability or tax payable for a person who is in business. So what is the examiner going to give you? The examiner is going to give you what we call a statement of profit or loss. If I can open up a sample statement of profit or loss and you see what I am talking about. This is a sample of a statement of profit or loss. If I can use this example. You have something that looks like that. And in that statement of profit or loss, you have a summary of the statement of profit or loss and other comprehensive income, where you have items, where you have notes, and you have amounts. Sometimes they don't give the notes in here, sometimes they give the notes. So when they give you the notes, first of all, the examiner has cheated for you and saying, please go and look at these notes. There's something that you need to take the tax computation. So this is a summary of the statement of profit or loss, but the details are going to be provided in additional information. The reason is when you look at the face of the statement of profit or loss, you can never know what exactly is embedded in each of these items because the accounting rules require that you present only the summary and then the details you put them in the notes, the financial statements. So these are the notes of the financial statements. Now your strength is how you look at these notes, and these notes are going to be both incomes and expenses. But on top of those assets, as long as they are not buildings or land, you know that you're going to actually draw the wear and tear schedule. Because students have kept on asking me, how do I know when to compute certain capital deductions? So when you see a table like this, and you're going to see, you just know that you have to draw the wear and tear schedule because you're looking for depreciation allowance. When in the assets you have a building, if in the assets they have given you a building, you just know that you're going to look for industrial building deduction. That's what the examiner is focusing on. So the details are there, and the question will be asking you to look for chargeable income and tax payable for the year. It will either be an individual or a non-individual. The question is, you as a student, what do you do when you see that question? This is what we are going to do now. When you see that question, automatically you want to earn as many marks as you can in the shortest possible time. So what do? You go and draw up your tax computation structure. That is your element number. Before you even look at the whole question, the moment you see the question asking you to prepare or to determine the chargeable income, tax payable, tax liability, you just go directly and draw your format. The reason why I want you to go and draw your format before you read through the question is because there are those obvious things that you're going to get in the first minutes. And when you earn 5 marks so quickly, it is easier for you to get the confidence that you're going to pass. So the moment you see your number 1 asking, for example, to determine the chargeable income and tax payable or tax liability, it simply means they want you to draw the income tax computation. The income tax computation, and it has a standard format. The standard format, like I'm going to take you through, requires that you put the heading. And the heading is drawn from the question itself. So do not start writing and you don't know whose computation you are drawing. So if I am drawing a computation of, for example, TUL, I would say computation of TL's chargeable income and tax payable for the year ended 30th June 2024. There you have earned, whether it's half mark or a full mark, but at least you have something to start with. Number 2, you must set your formats. And when you set your format, you're going to draw 3 columns. The 3 columns, the first column is going to be for the description of the items that you're going to put in. The second column is going to be for any adjustments that you want to make. And then the third column should be only for the final figures. Now, when you draw your tax computation, it has specific headings that you're going to put in before you look at the details. And the first heading is the profit or loss before tax. And this profit or loss before tax is a free mark because it is going to be given to you from the statement of profit or loss. And this is what I am talking about. This figure that you have in the summary, it can be either a profit or a loss. If it is a loss, it's going to be in brackets. If it is a profit, it's going to be not in brackets. But that is the figure that you start with in the tax computation. And be careful, because the examiner in the statement of profit or loss, they have so many profits. We have the profit before interest and tax. We have the profit before tax. We have the profit for the year. We have the net profits. But you're looking for the profit before tax. If the name is not like that, you should be able to look, even if they call it net profit, as long as they have not yet subjected it to tax. So that is what you're looking for. If it is a loss, you bring it as a loss. The next subheading you have in your template is to add back non-allowables. And I want to emphasize today, when they say non-allowables, they simply mean that there are certain expenses in here which they charged from the sales, from the income, which were not supposed to be charged. And that is where you need your knowledge. And this is where these examples I'm going to give you are going to help you to know which items are non-allowable. But basically we are saying, look at the details of the expenses they have given you in the question and pick out expenses that are not supposed to be deducted from the profit, because you have started from the profit. You've started from the profit before tax. Which profit was derived from? Incomes minus expenses. So the question is, are there any expenses that were deducted in the statement of profit or loss, which were not supposed to be deducted, that we are calling non-allowable deductions? The impact means that it reduced our profits when it was not supposed to reduce our profit, and we want to add it back. Now, when you say add back non-allowables, please leave a page. Leave a page, because you don't know how many non-allowables you're going to add back. If you peruse through the question and you see that the question is very short, then you can leave like half a page. But if you see the question is very long, then you must anticipate and leave enough space like a page. You're not the one buying the papers, so leave enough space. Once you've left enough space, remember number one was the profit or loss before tax. You've already extracted it and put it in the last column. There are 3 columns, remember. Number 2 is that you're going to add back the non-allowables. Now, you list all the non-allowables as we are going to see them shortly. And then, remember, you have left half a page where you're going to fit all these items. And then you have to get to the total of your add backs. When you get to the total, you put it in the last column to find the other profit or loss, because you want to add the add backs onto the profit. And you're saying these expenses should not have been reduced from the profit. I am adding them back. So you have 2 figures now in the third column: the profit or loss before tax, and then the total of the add backs. The next item is less allowables. Less allowables is your third line. Now, in the less allowables, whereas in the non-allowables, we are looking at expenses that you're adding back. In the less allowables, we are looking at both incomes and expenses. Why? Because in the less allowables, you're looking for incomes that had been included in the statement of profit or loss, but which should not be taxed. I repeat, when you look at what forms the incomes, what forms the incomes in your statement of profit or loss is a line of revenue and also a line of other incomes. Now, there are incomes in revenue, there are incomes in other incomes, which are not supposed to be taxed in accordance with the law. The law has said these incomes, you can recognize them for accounting purposes, but when it comes to tax, we cannot tax these incomes, and we call them non-taxable incomes. Now, or we call them incomes that cannot be included in the gross income. So if they were included in the statement of profit or loss, how should we adjust them? We go and remove them from the profit, because they had increased the profit, yet they are not supposed to be taxed. So we go and remove them. So your skill is to look at the line of revenue and also look at the line of other incomes in the details, because they will break down for you what in the revenue is, what is in other incomes, and ask, are there any incomes in these revenue and other incomes that should not be taxed? And if the answer is yes, you come and put them under less allowables. That is for income. Number 2 is for expenses that the taxman allows, but for you had not incorporated them in the statement of profit or loss. So when you look at this statement of profit or loss, the accountant has considered the expenses that for him he incurred and are allowed according to the accounting principles. The taxman has other expenses that we call allowable deductions that he can give you when the accountant did not give them to you. So these expenses are not going to be coming from the statement of profit or loss, but they are those that are provided for by the law, and you must consider them. So those are the expenses that we are going to actually consider down here. Remember, we are still on line number 3. Now, after aggregating your less allowables, you also put the total in the last column. So now we have three figures. We have the figure of profit or loss before tax. We have a total of add back, and we have a total of allowables. There are three figures now. Remember, the first question was asking you to draw the chargeable income. Now, chargeable income is getting the profit or loss before tax plus the add backs minus the allowables. Those three figures give you your first answer, called chargeable income. I repeat this because it's very important. The first question is for you to get the chargeable income. How do you get the chargeable income? Get the profit or loss before tax. You add back the total of the add backs. You subtract the total of the allowables, and the result will be called chargeable income. Are we together up to that point? Before I come to the details, remember we are still now listing the format, and we said on the add backs you leave a page, on the allowables leave a page, and then you can be able to get your final figure as chargeable income. After chargeable income, you actually have one adjustment that you must make, and that adjustment is called a carry forward loss. That carry forward loss is a free mark. Why do I say it is a free mark? Because the examiner is going to give it to you. You only need to know where to place it. And I'll give you an example. If you look at this question, I want you to see the last statement in this question as an example. It says TEUL paid 1 billion as provisional tax. That's one free mark. Number two, and had an assessed loss. When they say and had an assessed loss in the previous year, that is what we call a carry forward loss. All you need is to go and place it in the right place. It can either be called an assessed loss, or the examiner will actually tell you he had a loss in the previous year. All he's telling you is that now that is a carry forward loss that must be subtracted from the chargeable income. And then we have provisional tax, we have withholding tax. I'm going to get to those, but I wanted to illustrate to you how a carry forward loss usually comes in. They are either going to call it an assessed loss of the previous year, or the examiner will tell you that there was a loss sustained in the previous year, and therefore you should bring it in the current year. So you get to that carry forward loss and remove it from the chargeable income, meaning the carry forward loss is also going to go in the third column. Now, when you remove the carry forward loss, you have your adjusted chargeable income. And the adjusted chargeable income is what we are going to subject to tax. The adjusted chargeable income is what we're going to subject to tax. Now, pay attention. At that point, then you ask yourself, am I dealing with a company? Am I dealing with an individual? When the number is about a company, then you apply 30% on that adjusted chargeable income. When the number is about an individual, then please do not apply 30%, but rather turn your the question sheet. Behind the question sheet, there are rates for individuals. If you have been revising, you must have seen every question paper at the end. They are what we call individual income tax rates for residents and non-residents. In those rates, you're able to see what chargeable income is and the rate that is applicable. Those are the rates that you apply if it is an individual. Are we together up to that point? When you apply the rates, it means you have got what we call a tax payable. You have got a tax payable or a tax liability. The next question you ask yourself, do I have any tax that I have paid before in that year, which gives me a credit now that should reduce my tax liability? Because you have now determined your liability. The question is, have I paid any tax before. And that tax that you have paid in advance can be categorized into three. Number one, we have what we call a foreign tax credit. Foreign tax credit is that someone that you're dealing with, the computation you're doing, someone also earned income outside Uganda and they were charged tax. Because you have added their income in the tax computation, you must also give them a credit of the tax they paid outside Uganda. That is what we call a foreign tax credit. And if it is there, the examiner is going to tell you there is a foreign tax credit. Oh, this person earned this money outside Uganda and he was charged a tax of this much. That is what we call the foreign tax credit. Number two is what we call withholding tax credit. Now, withholding tax credit, the examiner is going to tell you blankly what it is. For example, in this question, the examiner says the company also had withholding tax credits of 500 million. All you need to know is where to press that amount. The last thing that you reduce from your tax computation is the provisional tax paid. Now, I want you to imagine a paragraph like this, paragraph 8, gives you 3 straight marks. Because in this paragraph 3, we picked the assessed loss, which is the carry forward loss. We picked the withholding tax. We also picked the provisional tax. Now, some students were asking, but why are these taxes not expenses? Taxes are not expenses. If you pay withholding tax, if you have paid provisional tax, those are only used to reduce your tax liability. Now, we said after getting the tax payable, the next thing is reduce the credits. But before you reduce the credits, I don't want to take any chances because the examiner could ask you something related to this. There are entities that are employing persons with disabilities. If they give you a question and you see the examiner is saying that this entity employs persons with disabilities and they form at least 5% of the full-time employees, those entities have a special deduction. But that special deduction comes at the point after you have calculated tax payable. That entity will qualify for an additional 2% of that tax payable as a deduction before you can know how much they are going to pay. So if you're dealing with it's very rare, but I have seen it before. And I don't want to take chances because when you go through my hands, you should be able to get 80% and more. So to get 80% and more, it means you must be able to at least have more knowledge than anyone else will have. So there is that special provision in the law that favors those persons that employ persons with disabilities. So when you see this 2%, it is only strictly for those persons that have employed persons with disabilities and those persons with disabilities at least for 5%. If you see a question like that, after getting tax payable, calculate 2% of that tax payable. And then you will reduce it from the tax payable because it is a benefit to those people who employ persons with disabilities. Because it is a rare case, if you're not dealing with a person employing persons with disabilities, ignore that 2%. You don't need it. And therefore, from the tax payable, you'll be removing your credits. And we say the credits are foreign tax credits, withholding tax credits, and provisional tax paid. Remove them and you'll be getting your outstanding tax liability. And that will mark the end of that number. Now, I want to go back to the different add-backs and allowables so that you know when I see this item, I should actually be able to take it to the add-backs. I should be able to take it to the allowables. So let's go back. Our format is now ready at this point. Remember how we moved? We started from the profits. By the way, that should flow in your head before you enter that exam. Because you're not going to think about the format in the exam. Whether you're going to rehearse it, whether you're going to do what, make sure that the format flows in your head. Where do we start from? The profit or loss before tax. Put it in your third column. Add back non-allowables. The details of the non-allowables, put them in the second column. When you get the total non-allowables, get the total and put it in the third column. The next one is less allowables. Also list all the allowables and put them in the total, put it in the third column. Now, get the profit or loss before tax. You add back the total of the add backs. You subtract the allowables, and what you get is chargeable income. From chargeable income, you remove the carry forward loss. You get your adjusted chargeable income. On the adjusted chargeable income, apply the tax rates. And after applying the tax rates, then remove any tax credits that you've already paid. And these ones are foreign tax credits, withholding tax credits, and provisional tax credits. The reason why I'm emphasizing them in that order is because section 4, subsection 3 puts them in a priority order. When we are removing the credits, we start with foreign tax credits, we remove withholding tax credits, and finally, provisional tax paid. Now, because you're getting into the exam, you're not only going to draw the format, you must fill in the format. The question is, what are you going to fill in the format? The things that we are going to see in here, you are going to find them in the exam. Whether you want them or not, they are the ones that are going to be included in your notes. And therefore, your strength is you being able to pick them. If you're going to cram some of them, and when you see them, you have to put them in the right place, cram them. At this time, I will not like you to understand. Just cram if you can cram. All we need is, can you be able to place them in the right place? If you've not understood, the law is available, you will read them over and over again. But this time we are looking at passing, and the starting point is, can you be able to get the first 50 marks? And the rest is history. So let's see. The reason why I'm giving you these items is because I want you to see, when you see them, don't even think, put them where they are supposed to be. And then wherever there is an expression that is required, I'm going to tell you that. So, number one free mark is the depreciation. So I want to be confident that everyone that has gone through this probation pro bono class is going to actually add back depreciation. And it is definite you're not going to have a statement of profit or loss that has no depreciation. So that is the first item to add back. And it has no conditions. Depreciation is depreciation. You must add it back. Like I said, I am not now going to teach you. I am going to give you hints, because I would be now telling you, why do you add back this? Why don't you add back the other? Number two is to do with entertainment. Is to do with entertainment. And I'm going to give you examples of what the examiner has always put, for example, as entertainment. Now, entertainment simply means that the company has provided you food, meals, refreshments, and accommodation. Meals, refreshments, and accommodation, and general entertainment. Now, there is entertainment that is allowable, which you will not question, but there's entertainment that is questionable. So how do you know the entertainment that I'm going to add back? The moment the examiner gives you an item and calls it just entertainment, and has not added any literature on it, add it back. Because general entertainment is a non-allowable deduction. However, there is entertainment that is allowable. If they tell you that they provided for you meals and refreshments, for example, you're on travel to actually perform your employment activities, you're going to the field, what we call subsistence per diem, that is a normal business expense. If they tell you that the meals provided were also taxed on the employee, for example, they provided meals to the employees and they were taxed, that is allowable entertainment. If they tell you that these meals are provided to all staff on an equal term basis, then the employer also gets a benefit of that cost. In other words, there are items that have been examined before. For example, they tell you I don't know what is happening there. Who is writing in my presentation? So they tell you, for example, you went for a staff party. Staff party is a non-allowable deduction. You're entertaining your staff, yes, but it is not a business expenditure. They took you to Serena and you had the team building. That is not an allowable deduction. It is entertainment, but it's not an allowable deduction. So every time you say entertainment, the first mind is this is a non-allowable deduction, and unless they have given me information to confirm that this was the legitimate business expense, that's when it becomes an allowable deduction. Remember, if a deduction is allowable, it has no place in the tax computation. If you find that an expense in the statement of profit or loss is indeed a legitimate expense and should be allowed for tax purposes, please don't bring it in the tax computation. In the tax computation, we are only bringing non-allowable deductions. We are not bringing allowable deductions, we are bringing non-allowable deductions in terms of expenses. Number 3, expenses related to exempt income. Now, here you earn 2 marks at once. And I want you to learn this trick. The moment they give you any exempt income, if you see in the statement of profit or loss and they have said this income is exempt, it means you earn 2 marks. Which ones are the 2 marks? You get that exempt income and remove it in the tax computation. But also the expenses related to that exempt income, you add them back because you want to put out this income together with its expenses. So the expenses related to that exempt income, add it back. The income itself that is exempt, subtract it in the tax computation. So you have 2 marks at the same time. Next one is what you call a loss on disposal. A loss on disposal of assets. Sometimes they call it loss on disposal, sometimes they call it loss on sale of the assets. The moment you see a loss on disposal, please add it back. Next one is, I am going to talk about the balancing charge when you go to the wear and tear schedule. So for this, paid it. But when we talk about the balancing charge, you just know that we are also going to add it back, and I'm going to tell you why we add it back. So I'm going to tell you what the balancing charge is and why we add it back. The next one is donations. The moment you see donations, the first mind is donations are not allowable deductions, but they have exceptions. They have exceptions. In other words, you can't choose to give a donation to everyone. When you look at donations, ask yourself 2 things. For it to pass as an allowable deduction, and you don't have to bring it in the tax computation, it must pass these 2 tests. Number 1, which entity did you donate to? Number 2, what percentage of your chargeable income did you donate? Now I'm going to answer those questions. And once I give you the answer, then you know that that donation is allowed and it won't come to the tax computation. But anything outside that I have said, then will have to be disallowed. It means that donation is not allowable. In other words, for you as a student, go knowing that the donation is not an allowable deduction, I should add it back. But the only time I will not add it back is when it passes these tests, these 2 tests. Number 1, it has been given to these 5 entities. Number 1, an amateur football association. Number 2, a charitable organization. Number 3, a religious institution. Number 4, a research institution of not-for-profit. So I said amateur sporting association, I said charitable organization, I said religious organization, I said research institution of not-for-profit. And the other condition that follows those entities is that they must have a certificate of exemption. If they don't have a certificate of exemption, if the examiner has told you or they have not told you that they have a certificate of exemption, please, he's saying they don't qualify to be donated to. If you donate to them, it is going to be a non-allowable deduction. Now, after they have, if those entities pass, the next question is, how much did you donate? Your donation should never exceed 5% of the other figure of chargeable income before we make any adjustment on the chargeable income. So you must calculate 5% of the chargeable income and then compare that 5% with the donation they are purporting to have given out. If the donation in the statement of profit or loss is more than that 5%, the excess over and above 5% becomes non-allowable. Are we together? Okay. Next is provision for bad and doubtful debts. Again, you also have 2 marks in here, because the provision for bad and doubtful debts sometimes can be in expenses, that is the normal place for provisions, but sometimes it can also be in incomes. When you see it in expenses, you know that they were either creating a provision or they were increasing the provision, but it becomes a non-allowable deduction. When you see it in incomes, it simply means that the provision had reduced. When a provision reduces, the accountant recognizes that provision in incomes, but it is a non-taxable income, and you should go and subtract it in the tax computation. I repeat this. A provision for bad and doubtful debts can either be placed in expenses, that is the normal place for it, but exceptionally, you can also find it in other income. Wherever you find it, if you find it in expenses, add back. If you find it in incomes, subtract in the tax computation. Next, startup costs. I recommend that you write your questions down so that we are able to ask, because once we finish the first part of income tax, I'll give you 5 minutes to ask before we can switch to another topic. Like I said, we have to tackle all the areas in the stipulated time that we have. So I'll keep timing myself to ensure that we are in time. So next is startup costs. Ladies and gentlemen, startup costs also have 2 ways you can deal with them. And you must know when to put it in the non-allowables or when to put it in the allowables. But startup costs, the examiner will tell you these are the startup costs. If he is not so straight, say these are startup costs, they are called preliminary expenses or pre-incorporation expenses. The expenses that you incur before you start the business are what you call startup costs. So how do you treat those startup costs? The law says that when you incur startup costs, you cannot claim them as expenses at once in 1 year. You must spread them over 4 years, meaning each year you can only qualify for 25%. Now let's see how the examiner is going to examine this. The examiner is likely to put this figure in the statement of profit or loss. I incurred 100 million of startup costs. So for me, it is an expense and I am expensing it. The moment you see it in the expenses, it means this guy has claimed more than the allowed 25%. So it means in that figure, there is an over claim of 75%. So calculate 75% of the figure he claimed in the statement of profit or loss and go and add it back. By adding back the 75%, you've only left him with only 25%. That is if he has claimed it as an expense. Sometimes he does not claim it as an expense, but rather puts a note in additional information and says there were also startup costs or preliminary expenses or pre-incorporation expenses. Remember, he has not charged it in the statement of profit or loss. The moment you find that they were not charged in the statement of profit or loss, you then calculate 25% of it and now take it in the allowables. So the only time you add it back is when you're adding back 75%. And it's when it has been charged in the statement of profit or loss. The time you put it under allowables is when it was not charged in the statement of profit or loss, and you want to give him only 25%, that is an allowable deduction. I hope we are together. The next one is unrealized foreign exchange loss. Unrealized foreign exchange loss. Again, you have two birds. You have one stone and you're going to kill two birds at once. Because the opposite of unrealized foreign exchange loss is unrealized foreign exchange gain. Unrealized foreign exchange loss is added back. Unrealized foreign exchange gain is subtracted. And the reason why we add them back or subtract them is because they are not yet realized. It then simply means if they were realized, you don't touch them. Because the examiner can ask you, can give you these 4 items. Unrealized foreign exchange loss, realized foreign exchange loss, unrealized foreign exchange gain, and realized foreign exchange gain. The only items that go to the tax computation are the ones that have unrealized. So if it is unrealized loss, add it back. If it is unrealized gain, subtract it. If they are realized, don't touch them. We move. The next common one, where you're going to get more than 3 marks, are expenditures or loss of domestic or private nature. And this is where you claim expenses that never exist for the business. The MD has incurred expenses, he has got receipts, first capture them. These are what we call private expenses, or expenses that the law has indicated they are private in nature. I want to give you the common examples that you're going to meet likely in your exam. Number 1, they paid school fees for the director's children. That is a private expense. It is not a business expense. Add it back. Number 2, they incurred personal expenses of the MD. The MD is traveling, you're buying him tickets. The MD at his residence, you're the one who pays the costs at his residence. The MD has a private meeting, you're actually incurring the cost. So any cost that you incur on individuals of the company that is private in nature becomes a non-allowable deduction. Funeral expenses. One of your staff has died or has lost a relative and they have contributed to the funeral expenses. That is a non-allowable deduction because it is private or domestic in nature. Holiday expenses. Sponsorship, the private sponsorships. If the sponsorships are not business sponsorships, if they are not business, they have sponsored an MP, they have sponsored some school, they have sponsored some game, they have sponsored the Rotary, they have sponsored, name those sponsorships. All those are private in nature and they are not allowable deductions. Sponsorships, subscriptions. You have subscribed for the MD or for your managers to the Kampala Club, to rugby, cricket club, to Rotary Club. Those are private subscriptions. Or you have subscribed to non-professional clubs. Now, when you subscribe to a professional body, for example, you have subscribed to ICPAU, you have subscribed to your UMA, Uganda Manufacturers Association, and those associations, Uganda Hotel Owners Association, those subscriptions that are business are allowable deductions. What we are talking about are those non-professional and business associations. You have bribed someone, kit kidogo. You know, there are businesses that can't survive without kit kidogo, both construction entities. Definitely, they will have some kickbacks, but those kickbacks are not allowable deductions. General expense is not supported by relevant documents. The moment they say this expense was not supported by relevant documents, you know the examiner is saying, please disallow it. Dividends to shareholders, all these are expenses that we are saying they are non-allowable deductions. This list is not exhaustive. The reason why I picked these items is because they have been examined over and over again. So there are examples that you can see and know that these are non-allowable deductions. Next one is expenditure or loss of a capital nature or included in the cost base of an asset. And examples that you're going to see, literally speaking, when you incur any capital expenditure, we know capital expenditure, you're purchasing an asset by whatever means it is, a motor vehicle, an equipment, a computer, whatever asset you're purchasing, that is not an expense. That is a capital expense that does not go to the profit or loss. So if the examiner told you that they want you to also use one stone to hit two birds, if you know that that expense was a capital expense, add it back in the tax computation, but also ask yourself, what is the capital allowance that I should give this capital expenditure? Because the capital expenditures qualify for capital allowances. So as you add it back, ask yourself, am I going to take it the wear and tear if it is plant and machinery? Is it a building? If it is a building, then I will go ahead and calculate the IBT. But once you add it back, also think about the capital deduction that you're going to give it. We have an example of principal payments, finance leases. If you pay for any finance lease, the principal part of payment is a non-allowable deduction. The interest is an allowable deduction. We already talked about losses on disposal, cost of buying assets, or borrowing costs. All these are capital expenses. We have expenditure or loss recoverable under any insurance contract or indemnity. If you make a loss but you are insured, that loss is a non-allowable deduction because someone has already compensated you for it. Next is income tax payable in Uganda or a foreign country. Every time you pay tax, tax is not an allowable deduction. You have paid withholding tax, you have paid provisional tax. Please do not bring them as add-backs. They are not allowable deductions. Rather, do not bring them as expenses. They are non-allowable. So if they told you in the statement of profit or loss that some of the expenses that this person is claiming are taxes, income tax, withholding tax, and all that, because in the exam they will make all the mistakes that they want to make and see whether the student is going to actually pull them out. So the examiner can add anything in the statement of profit or loss and is testing whether you're able to pull it out. Any income carried to the reserve fund or capitalized in any way, those are provisions. Every time you see a provision, please add it back. Gifts made to individuals. They have given an individual gift and they have not taxed this individual on this gift. It becomes an unallowable deduction. Fines and penalties or bribes, that's very common. The moment you see fines and penalties, please add them back. It doesn't matter how legitimate the penalty is or the fines. As long as you have been fined by any government authority, that fine or penalty is an unallowable deduction. The next item that is very common is employee contribution to the retirement fund. Ladies and gentlemen, this is where the examiner tricks you. He tells you, we all know that we contribute 15% to NSSF, not so. But the 15% where it comes from, the employee contributes 5% and the employer contributes 10%. And therefore the expenditure on the employer is only 10%. It is not 15%. So if they tell you there was a contribution in the retirement fund and it was 15% contribution, the examiner is indirectly saying compute 5% and add it back because that is not an expense of the company. I have a challenge with students who don't know how to calculate 5% once they have been given 15%. If they give you a figure and they're saying this is 15%, to get the 5% out of it, you get 5 out of 15 times that figure. You don't apply 5% directly to the figure. You get 5 out of 15 times that, figure the according 15%, and then that 5% is what you add back. The next one is what you call life insurance premiums or similar payments. If a company pays for life insurance premiums or similar payments, those are not allowable deductions. If a company pays for pensions, they are non-allowable deductions. I'm going to jump some of them. Any alimony allowance paid under a judicial order or written agreement of separation, non-allowable. I am going to emphasize these two because these are common. If you make any expenditure, if the examiner tells you that this expenditure was made with the supplier who did not have a team, and this expenditure is above 5 million, that expenditure becomes a non-allowable deduction. I'll give you an example. You go buy something at 6 million, but the person who has sold it to you has no team. That 6 million is added back because it has become a non-allowable deduction, whether you paid for it or not. Because the law has said that if you incur any expense with the person who has no team, and that expense is above 5 million, then it becomes a non-allowable deduction in whole. If it was 100 million, the whole of it is added back. If it was 6 million, the whole of it is added back. If it was 5.1, the whole of it is added back because you have violated the law. The other hard condition is if you purchase anything from anyone who is registered for VAT, but you do not get an e-invoice. So when you see the language of the examiner saying, you actually purchased this, but you did not get an e-invoice, he is indirectly telling you that that expense now is a non-allowable deduction. Please add it back. Okay. Provisions, I already talked about them. Amortization, the same as depreciation. Impairment of assets, add them back. Expenses related short-term business. Costs directly attributable to mining, those are rare. Now, this one is very common. Total expenses purely related to rental income. Please pay attention on this. This is also going to give you 2 marks. And it's very common at your level now. At taxation and advanced taxation, you're going to see this. In your statement of profit or loss, sometimes you find in your revenue, they tell you that in this revenue also includes rental income. You got expenses, and you also discover that the expenses related to rental income. It means you have more than actually 2 marks. And this is how you get the marks. When they give you a number that has an element of rental income in it, you are going to earn more than 1 or 2 marks. But the first 2 marks are these. Get the rental income, go and subtract it in the tax computation. Get the expenses related to rental income, add them back. And I want to emphasize, expenses related to rental income is not the same as rent expense. Expenses related to rental income means you are a landlord earning rental income, but you incurred related expenses. When they say rent expense, you're the tenant. Rent expense is okay. It's an allowable deduction. But here we are talking about a person who is in business, but also has rentals. For him, when he's preparing his statements of profit or loss, he's going to mix them in the statement of profit or loss. But when you find them, the law says rental income must be taxed separately. So how do we remove it? You go to the tax computation, under less allowables, you subtract the rental income that you got from the statement of profit or loss. You go to add backs, you add back the expenses related to that rental income. It simply means then that you have removed it from other gross income. But have you finished? No. You must now then go and calculate rental tax separately. You must do a working of rental tax for you to be able to earn all the marks, because you are saying rental income is taxed separately. I have done my income tax computation. I have subtracted it, and I've also added back the related expenses. So can I put it on the side and tax it separately? And I'm going to comment on how we tax rental income shortly. The other thing is, of course, any other non-allowable deduction. We can never point them all. But as long as, guys, if in your heart of hearts, you read an expense and you know that this expense was not incurred in the production of income that you have included in the gross income, please add it back. In other words, when you say this expense, really it is not a business expense. Use common sense at that point. If you see an expense that we've not talked about, use common sense. Is this an expense, a business-related expense? If the answer is no, it means it becomes a non-allowable deduction. Now, I want to quickly take you through the allowable deductions or the common examples of allowable deductions that you're going to find, and then we actually call that number one. And I will entertain the questions before we can stretch up. When it gets to less allowables, guys, less allowables is the mixture of incomes and expenses. Now, I want you to pay attention. I can only bring incomes here if these incomes were in the statement of profit, or, I repeat, if under less allowables, I am going to put any income there, that income should have been in the statement of profit, or, and I am now removing it because I am saying it inflated the profits. I want now to remove it because the law has said it is not taxable. So I do not want to say to remove incomes in the tax computation, yet these incomes were never in the statement of profit or loss, because you cannot less what was never added in the statement of profit or loss. Just like we cannot add back what was never subtracted in the statement of profit or loss. So what are some of these incomes? Number one, exempt income. That in the statement of profit or loss, when I look at revenue, when I look at other incomes, the examiner has told me that this income is exempt. So where do I place it? I go and subtract it in the tax computation. Number two, profit or gain on disposal of assets. First of all, a gain or loss on, whether a gain on disposal is always in other incomes in the statement of profit or loss. But we are saying it is not taxable. Come and subtract it. Now, we say this place is an amalgamation of both incomes and expenses. When did you bring expenses in here? And I want you to open your ears properly, because this is where the biggest mistakes come. The person has said less allowables. And for him, when they go to the statement of profit or loss, they already confirm this one is a legitimate expense, it's an allowable deduction. So when they come to tax computation, they also want to bring that expense that they've already passed and bring it in the tax computation. That is wrong. If you're bringing an expense as an allowable deduction, it means this expense was never charged in the statement of profit or loss, but the taxman allows it as an expense. Open your ears again. For me to bring the expense in the tax computation under less allowables, I am talking about an expense that was never in the statement of profit or loss, but the taxman allows it as a deduction. In other words, you're giving this person additional deductions that were never considered by the accountant, but the tax law allows them. What are the examples of those ones? They are capital deductions. Now, never forget, you are not going to do any number and then you don't compute capital deductions. Number one capital deduction is the depreciation allowance, which is going to come from the wear and tear schedule. So when you draw the wear and tear schedule and you get the depreciation allowance, you put it in the tax computation as an allowable. Number two, industrial building deduction. And like the word is, industrial building deduction is on buildings. Please do not calculate industrial building deductions on the motor vehicle. Industrial building deductions are on a building. Number three, we have what we call startup costs. I already talked about startup costs. That's when the 25% becomes relevant here, if it had not been deducted in the statement of profit or loss. Number four, there's what we call costs of intangible assets. Cost of intangible assets. Now, when you have an intangible asset, again, you have 2 marks that you can win here. Because the amortization of an intangible asset is always included in the statement of profit or loss. Or sometimes they actually include there the whole cost. I have a software and I am including it in my expenses in the statement of profit or loss. The cost of the software is a capital expenditure. So what do? I add it back. But as I add it back, the law has said that such an intangible asset deserves to have a capital deduction. So how do I calculate the capital deduction? I get the cost of that intangible asset divided by the useful life. And that figure that I get is what I include in my less allowables, because it is a capital deduction. So you see how you pick the 2 marks at once. If the cost was included in the statement of profit or loss, first add it back, even if it is just amortization. If they amortize it and put it in the statement of profit or loss, first add it back. But remember, there's a capital deduction related to that intangible asset. How do you calculate it? Get the cost of the intangible asset over the useful life. That figure that you get, take it to the tax computation. Number 3 that I want to emphasize in the capital deductions is what we call farming allowances. Farming allowances. At least if you forget, don't forget all the capital deductions. At least remember that it is. And some of them are actually, the examiner is going to cheat for you. Because if I give you a note that has classes of assets, shouldn't you really remember that you have to draw the wear and tear schedule? And when you draw the wear and tear schedule, shouldn't you remember that in the wear and tear schedule you're looking for depreciation allowance? And when you get it, take it to the tax computation. When you see a building, just know the examiner wants you to test IBD, industrial building deduction. And once you get it, take it to the tax computation. Now, I had talked about farming. In farming, you're going to see about 3 things. Number 1, there's what you call horticultural branch. Number 2, there's what you call greenhouse. Number 3, there's what you call farm works. There's what you call farm works. Now I want to teach you how to deal with it. And I'll start with farm works. Farm works, the common feature of farm works are called labor quarters. The moment you see a word labor quarters, it means they are talking about farm works. Now, those labor quotas go to the wear and tear schedule under class 3. So if you see labor quotas, you just know they are talking about farming expenditure, and those labor quotas, what we call farm works, will go to class 3. So you take them to the wear and tear schedule. If they are talking about a horticultural plant or a greenhouse, don't take it anywhere, but apply a 20% on the expenditure for the greenhouse or horticultural plant. And that is what you're going to take as an allowable deduction. I am repeating this. If you see the examiner talking about these 3 items, number 1, horticultural plant. Number 2, greenhouse. Number 3, farm work. And in farm works, the common one is labor quotas. You just know they are testing on farming expenditure. But how do we treat these 3? For farm works, or call them labor quotas, you take them to the wear and tear schedule class 3. For greenhouse and horticultural plants, you do not take them to the wear and tear schedule, but rather you apply 20% as a capital deduction. And therefore, once you have calculated that capital deduction on greenhouse or horticultural plant, you take that figure directly to the tax computation as a capital deduction on the greenhouse and horticultural plant. Then the labor quotas have already gone to the wear and tear schedule. That one treats it in the wear and tear schedule. Now I repeat, don't get out of the exam without calculating at least any of these capital deductions. At least you'll be sure you're going to get a depreciation allowance. Why should you fail that mark? And the wear and tear schedule will give you more than just a mark. You have IBD. Once you see a building, think about IBD. We have the intangible assets. We have the farming expenditure. Think along those lines and you'll be able to get some of the capital deductions. The next one is scientific research expenditure. If you see any scientific research expenditure, it is a capital deduction. It is an allowable deduction. I have already talked about unrealized foreign exchange gains. Those ones you see them in other incomes, come and subtract them in the tax computation. Reduction in provision for bad debts, I already talked about it. Now, there is this that I want to pay particular attention to. And that is the last income that I want to explain on. Gross income credited POL on which tax withheld is the final tax. What this simply means in simple terms is that this income has been included in your statement of profit or loss. And usually it would be in other incomes. And which kind of income is that? And the examiner is telling you, or the law is telling you, that if this is the income which has already been subjected to withholding tax as a final tax, then pull it out. The accountant recognized it in other incomes. But has it suffered withholding tax as final tax? If the answer is yes, then pull it out. How do we pull it out? Go to the tax computation and subtract it. So what are these incomes which have already suffered withholding tax as the final tax? And when you see them, you must go to the tax computation and put them under less allowables. And I can confirm with certainty, you cannot finish an exam without one of the incomes. So you're very sure that you're going to find it. You must remember it and pass it. Now let's see. These are the incomes. And there are about 4 incomes. And now I want to warn in advance. Out of the 4 incomes, the only income that is relevant to a company, if you're dealing with a number of a company, is only one. The rest will be relevant if you're dealing with an individual. Am I making sense? I am trying to make sure that I make it as easy as possible for everyone to remember. There are about 4 incomes that I'm going to talk about. And these incomes are only deemed to have been subjected to withholding tax as a final tax in the hands of either a company or an individual. The only time a company will surface as having suffered withholding tax as a final tax is only on one category of income. It simply means that when you're dealing with a number of a company, you only look out for that income. And if it is not there, then do not take out any income to the tax computation. So number 1 is interest on treasury bills and government securities. Interest on treasury bills and other government securities. The moment you see that, you just know that that income must be taken to the tax computation and subtracted, whether you're dealing with a company, whether you're dealing with an individual. Interest on treasury bills or bonds and other government securities. The moment you see that income in your other incomes in the statement of profit or loss, don't even bargain. I told you some of the things you must grab them and first pass them. Go and subtract that income in the tax computation, whether it is an individual, whether it is a company. Now, the rest of the incomes that I am going to talk about, you can subtract them if the number you're dealing with is for an individual. If it is a company, don't bother. Leave them where they are. And these are the following. Number 1, interest from financial institutions. Interest from financial institutions. When it is in the hands of an individual, it is considered final. But when it is in the hands of a company, it is not final. Whereas the bank would subject all of them to withholding tax, but in the hands of a company, it's not considered final. And therefore, when you see interest from a financial institution and you're dealing with the number of a company, please don't subtract that income. But when you finally finish your tax computation, among the credits you're going to remove, you will remove 15% of that income they had put as interest from financial institution, fixed deposit accounts. Because that bank, that company has already suffered 15% of that income. And we said that that withholding tax has become creditable and not final. I repeat that. If it is interest from a fixed deposit account or from a financial institution, in the hands of a company, it is not final. The tax is not final. What does that mean? That you don't go and subtract the income in the tax computation. You leave it in the income that is going to be taxed again. So it is taxed again. But when it is taxed again, then this company says, you know, you have taxed me again, but the bank had already taken my 15%. So can you give it to me as withholding tax credit? That's where it actually comes. If it is an individual, then it has suffered withholding tax as a final tax. Go and subtract it. The next income is commission on airtime distribution and money, mobile money, and mobile money. Commission on airtime distribution and mobile money. If it is in the hands of the individual, go and subtract it. If it is in the hands of the company, don't bother. The next one is dividend payments. If they have been received by the individual, go and subtract it in the tax computation. If it has been received by a company, please don't bother. I am going to repeat this for the last time. Among these incomes that I've talked about, there are 4. The only time you consider taking an income in the tax computation for a company is only once. And that is on interest, on treasury, bills, and other government securities. On other occasions, please do not take out that income to the tax computation. If it is an individual, then you have all the 4 chances. Interest on treasury bills, interest on from financial institution, commission on airtime distribution and mobile money, then dividends, all that favor the individual. If it is earned by an individual, it will be subtracted because it can't be taxed again. Finally here, am I still on the? No, there are still 3 things. There are also other, there's another free mark. It's what we call a minor capital equipment. Remember we said, once you incur a capital expenditure, it is not an allowable deduction. Not so. But we have an exception. If I purchase an asset, but this asset's cost is less than 1 million, we call it, if this asset's cost is less than 1 million, whether you have bought 1 million assets, as long as each of the assets is less than 1 million, and this asset can work on its own. For example, I have bought this furniture. Each of them is, say, for example, is 700,000. Even if I have bought million furniture and I incurred 10 billion shillings, that would be considered a minor capital equipment. And therefore, minor capital equipments do not go to the wear and tear schedule, but rather they are taken as an allowable deduction at once. So if among the additions, because they're going to give you assets, look at this. Look at this, look at this. When they give you these opening balances, the next thing they will tell you the assets that were purchased. Not so? So I want you to see an example of an asset like this. Purchase 10 office chairs at 230,000 each. It simply means that if you multiply 230 times 10, definitely it will go beyond 1 million, but each of the items is less than 1 million. So the aggregate of that cost qualifies to be a minor capital equipment. So that furniture, I wouldn't take it to the wear and tear schedule, but rather I take that total cost to the tax computation directly as a minor capital equipment. Because the chairs can stand on their own. If it's a computer like this, it can stand on its own. If it is less than 1 million, then it is a minor capital equipment. Next is balancing allowance. I'm going to explain what a balancing allowance is, and then other allowable deductions, if any, and then you'll be able to complete your number. Now, in less than 5 minutes, I want to show you the computation of the wear and tear schedule. I know that you actually know this, so I'm not going to spend time, but you must know how it runs. The wear and tear schedule is 1, 2, 3, 4, 5. It's a 5-column table. It's a 5-column table. It has your description of the items. It has class 1, class 2, class 3, and then the total. Class 1, class 2, class 3, and then the total. Guys, the percentages you see here of 40%, 30%, and 20%, the examiner is not going to give them to you.
Excuse me, sir.
The examiner is not going to give them to you. And now some of the things you take them for granted. You get into the exam and you don't remember. whether class 1 is 20%, whether it is 30%, whether it is. That's why I don't take these things for granted. Class 1 is 40%. Class 2 is 30%. And class 3 is 20%. Ladies and gentlemen, the figures they give you in the notes in your question are opening balances. These figures that you see here, these ones, are opening balances. So I take them as free marks. And then after the opening balances, they are telling you these are additions, these are the assets that were purchased. Put them in the right class. They will also tell you the assets that were disposed of, because all you need are the opening balances, the assets that were purchased, put them in the right class. And then if there are any assets that were disposed of, put the sales proceeds in the disposal in as subtractions. And then when you get the opening balance plus the additions minus the disposals, you get the net assets. It is on this figure of net assets that you apply the rates. If it is class 1, apply 40% there. If it's class 2, apply 30% there. If it is class 3, apply 20% there, so that you're able to get the total of depreciation allowance. That depreciation allowance is what you're taking to the tax computation. And then you have your closing balances. That will be your wear and tear schedule. Important to note is that in all the 3 classes, class 1 only accommodates computers and data handling equipment. And when they say data handling equipment, it is not anything else that you want to actually say is a computer. If I hold this phone, I can say this phone is also a computer. But in that class, we use it sparingly. And therefore, in that class, you're only going to put there computers and servers. Computers and servers. Now, when it gets to class 2 is also used sparingly. Please always ask yourself before you put anything in class 2. I would rather risk putting nothing in class 2 than putting the wrong asset. Because class 2 only accommodates assets that are strictly used in mining, manufacturing, or farming. So if this person is not in mining, is not in manufacturing or mining, it means class 2 will not have any asset. Also learn how to cheat exams, because you're going to be given a number. If you're given a number, for example, and they tell you class 2 has 0, then if you don't know, if you're not sure, also think that this examiner is telling me that this person is not one who is in mining, manufacturing, and farming. Also, don't put the assets there. At least if I am going to, pick ponky, do I actually put it here? What is the examiner insinuating? So if you're not sure, please, and they have given you a hint, then don't put the asset there. But if you're sure that this person has an expenditure on plant and machinery, and this plant and machinery is used in manufacturing, farming, or mining, then put it in class 2. Any other assets, any other plant and machinery, your motor vehicles, your furniture, your equipment, your engines, your whatever you talk about, goes to class 3. I hope we are together up to that point. Quickly, I want to talk about the IBD. IBD is the easiest to do. The only trick with IBD is knowing the dates when a building was put to use for the first time. Because the formula is very clear. In other words, by the way, IBD is the depreciation of that building. And we give depreciation of only 5%. The formula is only for apportioning the 5%. Otherwise, if this building was an old building, and I'm calculating its IBD this year, I am only going to apply 5% of the qualifying expenditure without even putting anything. You only have to use the formula on a situation where the building that you're talking about was put to use in that very year that you're calculating, and it was not put to use at the beginning of the year, meaning you did not use it for 365 days. So when we say the formula is A is the 5%, B is the capital expenditure that you want to depreciate. And then C over D. C is the number of days you have used that building in that year of income. Over D. D is 365 days. So if I use this asset for less than 365, it means my C is going to be less than 365 days. From the date I put it to use, please we measure it in days and not months. So if the year of income you're dealing with is the year that started from July 2023 and is ending on 30th June 2024, it simply means that is a year of 365 days. But the question is, when was the building put to use? If it was put to use in the middle of the year, then count the number of days you have used it in that year, and that becomes your C. We are trying to apportion the 5% because the 5% represents the whole year. So we are trying to apportion the 5%. And you will actually be able to get your A times B times C over D. A is constant, 5%. B is going to be given to you as qualifying expenditure. And C is going to be the number of days you have used that building over the 365 days. And you'll be getting your IBD to take to a tax computation. Now, I want to stop here for number one. Of course, definitely, I have not said everything that I wanted to say, but I'm going to actually share with you. I have put a few notes for you to be able to actually remember certain things. For example, if I talk about IBD, it means I'm only giving it to industrial buildings, and you must know what an industrial building is. But without even being technical, the moment you see a building in the exam, I told you at this point, if you cannot understand it now, first program it. It means you see, the moment you see a building, you know the examiner is interested in you calculating IBD. Okay, so we are going to use 5 minutes to attend to your questions, and then we'll have a break and then come back. So remember, your number one takes the longest time, and that's why I'm taking the longest time on it. It gives you more than 40 marks, if not 40 marks. It means you have all your time on your number one, and then the other numbers are supplementary numbers. So your number one, if you fail number one, your ability to pass that paper is limited. So your number one is very, very critical. Okay, so I'm going to attend to your questions in the next 5 minutes, and then we'll have a break. There are questions.
Hello.
Yes, please.
Thank you, Thank you, Council, so much. I couldn't raise a hand, that's why I spoke. I had some few questions. One is, how can I get up there? Is there any apportionment for startup costs? Apportionment for startup costs. Then the other question is the treatment for intangible assets. First of all, if the intangible asset has been given and doesn't have a useful life, how do I treat it? If it has a useful life, what amount do I add and what amount do I less? Then I wanted to know about the balancing allowance and balancing charge. Is there a scenario where we can have both? And how do we handle these two? This one's confused me the way you're telling. Where the balancing allowance and balancing charge, how do they arise? And is there a situation whereby it can be two, you may have both of them? That's what I wanted to know.
Okay, so your first question is about, you asked about, pardon, startup costs?
My first question was startup costs. The other
Let's
question
answer one by one. Let's answer one by one.
Yes.
We said startup costs each year, you're given 25%.
Okay.
Now, you do not time apportion the startup costs. All we are saying is that year of income, you're only going to get 25%. That is question number one. Question number two was?
They're about intangible assets.
Intangible assets, we said.
If it's
Just
not
a minute.
given, if they are not given you the
I'm going to
useful
explain.
life.
I'm going to explain. Just go through. Intangible assets, we say they are given what we call a capital deduction. And how do you calculate the capital deduction? By getting the cost of the intangible assets over the useful life. He's asking if it has not been given the useful life, it simply means you're not going to calculate any allowable deduction on it. But a serious examiner would definitely give it a useful life. And I told you that if it has been included in the statement of profit or loss as the whole cost of that intangible asset, either software, the cost of the software, you first add back the cost of the software, and then you go to allowables, calculate the allowable deduction by getting the total cost or the capital expenditure divided by the useful life. And that is what you take to the tax computation under less allowables. The other question was about balancing charge and balancing allowance. Thank God you asked that. I want you to see this wear and tear schedule.
It's not visible.
And especially look at this figure of disposable and also the net asset.
We are not saying
Please
it.
We have just the question.
When you dispose of all the assets in a certain class, and the total assets is always composed of the opening balance plus additions before you get to dispose. Not so. So it is possible that you can have opening balance plus additions, but when it gets to disposal, you're disposing of all the assets in that class, meaning your net is going to be zero. Not so. Because you can't have a balance in the net assets when all assets in that class have been disposed of. But it is possible that you can get a gain or loss when you dispose of those assets at once in the class. My class 1 has opening balance of 100. I added assets of 100, meaning my assets are standing at 200.
We are not seeing your schedule, sir.
You're not seeing my schedule?
Yes,
Are you
please.
Yeah,
sure
we
you're
are
not
not
seeing the
seeing the
schedule?
question.
We're not seeing
No,
the
we are
table.
seeing the question.
It's only the question displayed.
Okay. Can you see this? Can you see it now?
Yes, please.
Yes.
Okay. I am saying this is our wear and tear schedule that we saw. Now, there is this price of disposals and there is this price of net assets. And I said for you to get to the disposals, it means you're disposing of the assets that you already have in the class. And the assets you already have in the class is either opening balance plus addition. Now, I was giving an example. Assuming class 1, my opening balance is 100. My addition is 100. It means at that point I have assets of 200 million. I now want to dispose of all the assets there. And I can either dispose them off at an amount more than 200 or at an amount less than 200. In the layman's language, when I dispose of at an amount more than 200, it means I have made a profit. Not so. That profit is not called a profit. It's called a balancing charge. It's called a balancing charge. And because it is a profit, it is taxable. That's why when we go to the tax computation, we put it in add backs. Because whatever we put in add backs, we want to tax it. And that's an exception of add backs. It's not an expenditure, but it is a place where you place your balancing charge so that it adds on your profit to be taxed. It means you have disposed of all the assets in that class, but dispose them at a profit. That profit is what you call a balancing charge. If you dispose them at a loss, that loss is called the balancing allowance, and it's going to be taken under less allowables. It simply means that when you're drawing your wear and tear schedule, it means these net assets will never go below zero. Any sales process that you get, as long as you know you have disposed of all the assets, you must balance your figure in the disposal so that your net gets to zero. But that imbalance is what you take as either a balancing charge or a balancing allowance. Is it possible to have both a balancing charge and a balancing allowance? Yes, because you're dealing with different classes. in one class, you might actually dispose all the assets and get a loss, but in another, you can actually dispose all the assets and get a profit. So you can have a balancing charge at the same time, a balancing allowance. A balancing charge is added back. A balancing allowance is subtracted. Next question, I now have, I'm going to mix the online and also the physical class. So the online, you've so far taken your chance. Let me now take one question from the physical class. Yes. Speak louder so that others can hear you. Okay. Someone has asked me that I talk about initial allowance. And I want you to see what I have put on the heading there. I said initial allowance was repealed. Repealing means removing it from the law. It was repealed effective 1st of July 2023. Now, what does that mean? It simply means that if you're going to do a number which spans before 1st July 2023, then you're going to have an element of initial allowance. If, for example, they say prepare a tax computation for the year ended 30th June 2023. If they say 30th June 2023, it means we are talking about a period when the initial allowance was still there. If they say prepare a tax computation for the period ended 30th June 2024, it means 30th June 2024 started on 1st of July 2023. And therefore, there was no initial allowance. My biggest thinking is that you're likely to have an exam of a period ending 30th June 2024. But of course, I am not sure. That's why I have to talk about initial allowance, so that in case they bring an exam that relates to a period prior to the repealing of the initial allowance, then you actually have an idea on how to calculate the initial allowance, because it is so easy to calculate. Now, if they bring you an exam of the year that ends 31st December 2023, the year ending 31st December 2023. Now that is where you need to be extremely careful. Why? Because the year that ends 31st December 2023, for it has a period where it is initial allowance and it has a period where there's no initial allowance. Now, the way we treat the law is that if your period, for example, starts from January and ends in December, for you, you first apply the tax law of the previous year before you transit. You transit in January. So the person whose year is ending 31st December 2023 will still apply initial allowance, and then will only transit in January 2024. Whereas someone whose year ends on 30th June, for him, he transited on 1st of July 2023. Are we getting the difference? Let me repeat this. It simply means that if the number is saying for the year ended 31st December 2023, you calculate initial allowance. If the year says for the year ended 30th June 2023, you calculate initial allowance. If the year is the current year and the current year that we are filing returns for, the reason why I'm saying your exam could actually be testing the current year, because we are now filing returns of 2023, 2024. That is the period that ended 30th June 2024. Those are the returns that you are filing now. So any serious examiner would be asking you to prepare the current return. So if you're preparing the current return of the year ending 30th June 2024, please don't think about initial allowance. But if they ask you for the year ended 30th June 2023 or 31st December 2023, please apply initial allowance. So what is the initial allowance? On buildings and the plant and machinery that we're talking about, there used to be an allowance called initial allowance. Now we'll start with building. Whenever you would put up a building and it qualifies as an industrial building, which is not an approved commercial building. I will repeat. Whenever you would put up a building which is not an approved commercial building, and I will tell you what an approved commercial building is, you would qualify for initial allowance of 20% of that expenditure that you have incurred. I repeat, whenever you would actually incur an expenditure on industrial building, and this industrial building is not an approved commercial building, the law would give you the first deduction of 20%. In other words, it would allow you 20% of that expenditure to give you back your cash flow so that you don't pay a lot of tax. Because the more deductions we give you, the lesser the tax. And that was 20%. So you would calculate 20% of the capital expenditure, and that would be taken as initial allowance. But please note, when you give an asset initial allowance, please don't give it IBD at the same time. So IBD and initial allowance don't go together at the same time. So if you decide that this asset you're going to give it initial allowance, as long as it is an asset prior to 1st of July 2023, if that is the number you're dealing with, you give it initial allowance, but you don't give it IBD. It simply means that that building must be a new building. If it is an old building, please don't give it initial allowance, because initial allowance is only given once when the asset is put to use for the very first time. So you can have these scenarios. They can give you two buildings. One is an old building, another one is a new building. But all of them relate to period prior 1st of July 2023. So the new building is going to be given initial allowance and no IBD. The old building is going to be given IBD and no initial allowance. Now, I said you do not give initial allowance to an approved commercial building. What is an approved commercial building? I have helped you and find it for you. An approved commercial building is an industrial building which is primarily used by the owner or let out for rent for purposes of carrying on a business, trade or profession, as an office, as a warehouse, or a commercial storage facility, or a workshop. So these items that I'm talking about, if you're using the building for doing your business, you're using it as an office, you're using it as a warehouse, you're using it as a commercial storage facility, you're using it as a workshop, that does not qualify for initial allowance. It only qualifies for IBD. How to get up to that point? That was for industrial buildings. Now, we also had the initial allowance on the items that go to the wear and tear schedule. Now, if you're going to deal with the initial allowance on the items that go to the wear and tear schedule, you ask yourself two questions. Because not all these items qualify for initial allowance, I am going to tell you which items qualify for initial allowance. So the two questions are these. Question number one, is this item an eligible property? What makes it eligible for initial allowance? There are two conditions. Number one condition, that this plant and machinery must be upcountry, must be outside the boundaries of Kampala, 50 kilometers radius. So if you buy a computer and you're using it in Mbarara, Mbarara is 50 kilometers away. Even Masaka is 50 kilometers away. It means that computer is going to first qualify for initial allowance because it has passed the first test. It is outside Kampala. Condition number 2 is that this asset should not be any of the three. It should not be a passenger or goods vehicle. It should not be a passenger or goods vehicle. Number 2, it should not be any appliance that we ordinarily use in households. Those things that you have in your homes, if you also have them in office, they don't qualify for initial allowance. The cookers, the heaters, the washing machines, the whatever you use at home, as long as it is also an asset that is with the company, it does not qualify for initial allowance. And finally, office or household furniture, fixtures, and fittings. So conditions are only 2. Condition number 1, that asset must be outside Kampala, 50 kilometers radius, minimum. Condition number 2, it is not any of the three. It is not passenger or goods vehicle. It is not an appliance ordinarily used in households, and it is not furniture, fixtures, and fittings. Once that is the case, it means as you're putting these assets in the wear and tear schedule, you're going to add another column for initial allowance. You actually add 2 columns, one for costs and another one for initial allowance. So this very table, this side, you add 2 columns, one for the cost, another one for initial allowance. Now the asset that qualifies for initial allowance, you give it 50% of that cost as initial allowance. And once you have given it initial allowance, please do not take it to any class. Don't take the balance to any class. And then later you aggregate the total of that initial allowance, take it to the tax computation. But we have said, and I want to emphasize, initial allowance is repealed from the law. And therefore, the only time you're going to think of it is when the examiner is asking you for a period. If it is a period ending 30th June, it must be before 1st of July 2023. If it is a period that ends 31st December, it must be a period before 1st of January 2024. Meaning the only time you think about initial allowance is when the number is saying 30th June 2023. You know that you have an element of initial allowance. 31st December 2023, you have an element of initial allowance. My thinking is your exam is likely to be for 30th June 2024. If it is 30th June 2024, there is no initial. I hope I'm clear and loud. Initial allowance on the items that go to the wear and tear schedule is 50%, whereas the initial allowance on the buildings is 20%. Okay. I want now 2 questions and then we go for a break.
Julius.
Yes.
I'm just inquiring that when we are given like on that part of industrial building,
yes,
calculation for industrial building, we are given
yes,
the cost of the building, and in the additional notes, we are given some other incidental costs. Do we have to consider them?
As long as the cost is a capital expenditure on that building. Now, if you are given an old building and you're also given other capital expenditure on that building, that capital expenditure always treat it as a separate building. That's the funny thing with the buildings. If they tell you this is a building and there is a cost of it, but you also incurred additional capital expenditure on this building, that additional capital expenditure is taken as a separate building. So you assume you have acquired a separate building. Yes, one from the physical class. Speak loud, I can't hear you. Okay, someone is asking how do we deal with a vehicle that I would call a roads vehicle, and a roads vehicle in layman's language is the vehicle that we actually carry passengers, me and you sitting vehicles that carry less than 13 passengers. And we call those expensive vehicles. The law has capped those vehicles 60 million. And because it has capped it 60 million, every time you buy such an expensive vehicle, in your wear and tear schedule, you're going to put that vehicle only at the maximum of 60 million. If the vehicle was 150 million, you only take there 60 million, because the law says that that vehicle is going to be divided into two. One part is going to be called the depreciable asset, another part is going to be called the business asset. It is only the depreciable asset that we take to the wear and tear schedule. We only deal with the other part called the business asset at the point when this asset is disposed of. And when it is disposed of, the amount we get from that vehicle, remember it is still one vehicle practically, and you have disposed it off. When you dispose it off, we also think that you have disposed of two vehicles, not so. So the process that you got from disposing of this vehicle, also apportion it among these two parts of the vehicle. And how do you apportion it? If, for example, the first vehicle, which was a depreciable asset, was 60 million, get 60 out of the total, which was 150, and multiply by the disposal proceeds, what you have actually picked, and it will give you the disposal proceeds of that depreciable asset. If you go to the business asset, again, you'll have the portion of the business asset. So you've divided the disposal proceeds. Is that okay? Now, the question is, how then do you deal with the business asset that you have disposed of? You must calculate what we call capital gains or capital losses. For you to calculate capital gains or capital losses on that business asset, you need two things. You need what we call consideration, and you need what we call cost base. Consideration is known. Consideration is that how much you have apportioned on the business asset as a portion of its sales proceed. So consideration is easy. What is hard is computing the cost base. Now remember, on a vehicle of 150, the business asset had how much? 90 million, not so. But that is not the cost base. You must depreciate that 90 million for the time that vehicle has been held. You assume, if I had put it in the wear and tear schedule, how much depreciation would it have suffered? So you depreciate that 90 until you get its net book value. That net book value becomes its cost base. So you get the consideration minus cost base, and you get either a capital gain or a capital loss. Once you get a capital gain, apply 30%. That's what they're always testing if you're dealing with that kind of vehicle. Trust me, I know that I am rushing, but definitely I told you I'm not teaching. I am only reminding you of things that I assume you've already studied.
Please,
Please, I hope that is the last question, because we need to break this, have a break, and then come back to you. I know you have so many questions, but you cannot cover them at once. Yes.
Relating to the provisional taxes, when we have estimated, they have given us the estimated provisional tax. Are we supposed to subtract the carried forward loss? Because
the moment the carried forward loss and the provision. First, listen. The carried forward loss and the provisional tax paid are two different things. The carried forward loss is subtracted from the chargeable income, whereas the provisional tax paid is subtracted from the tax payable.
Okay.
So both of them are considered.
So my question is that, sir, when we are calculating the provisional tax, like in real life, when we are
you're not going to calculate the provisional tax. I am not going to attend the real life calculation, because we are now dealing with the exam, but I am available if you want to know how it is calculated in real life. I am going to teach you how it is calculated. But for now, know how to deal with it in the exam.
Okay, thank you very much, sir.
You're welcome. I am now dealing with academicians. If you have anything to do with the practice, Please, that should be offline because we want to make sure that we first pass the exam. Yes.
Excuse me, sir.
Okay.
Excuse me.
I think I'm only going to allow 5 minutes, only 5 minutes for this. It is 20 minutes past 10, so at 25 minutes we'll break for this first question and we have a break. I am attending to the physical question now for now. I mix the online and the physical questions. Kazu. Yes. Make sure that your question is very brief. Yes. 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 Now, when you're calculating the percentage of 5% of donations, you first get your chargeable income as we have seen here. Do you see this figure called chargeable income? Where is it? The figure of chargeable income is here, before the carry forward loss. Once you do that, remember, you haven't considered the donation yet. Now you go to the income statement or the statement of profit or loss. Get the donation that was charged there as an expense. First add it on this chargeable income. What you'll be getting is a figure of chargeable income before you give out a donation. All together. Now calculate 5% of that total. Once you calculate that 5%, compare it with that donation in the POL. If that 5% is less than the donation in the POL, it means you claimed a bigger donation. Not so. The difference is what now you bring to your tax computation and add it back. Meaning, if you see a donation, don't write your chargeable income as yet. Just do a side work, because you know that in your tax computation you have an item of donation that you like it add back. So what you do, first get your chargeable income before considering that donation, then get the chargeable income, add back that donation in the POL. Calculate 5% of the total. If the 5% is less than the donation figure, it means you claimed more donation. The excess is added back. If the 5% is more than the donation, it is okay, your whole donation passes. You pass the donation that was in the statement of profit loss, and therefore in the tax computation you do not do anything because the whole donation is allowable. Yes. Now, the only exception on the provision is either a financial institution or an insurance company. Those are the ones that are allowed provision for bad or doubtful debts. And those provisions must be specific provisions and not general provisions. Yes. Him and then I will close the question and answer session. Yes. Yes. Cost of sales. Guys, cost of sales has two elements. For the accountants, in the cost of sales, we have debits and credits. Because the cost of sales, the normal calculation of cost of sales is opening inventory, add purchases. Now, opening inventory and purchases are both debits because they are costs. But the moment you say less closing inventory, it means it is a credit. Now, if they make any mistake in cost of sales, don't rush, because people think cost of sales is an expense, and therefore if there's anything, I have to add it back. No, because cost of sales has two elements. It has both credits and debits. So whenever they say there is a mistake in cost of sales, ask yourself what that mistake has to do with the gross profit. If the cost of sales were overstated by that mistake that there is, or by that cost that should not be there, if the cost of sales were overstated, it means the gross profit has been under, and therefore if you're correcting that error, you will go and add it back. If the cost of sales had been understated, it means gross profit has been over. If you're correcting it, go and put it under less allowables. So you must know what impact does the mistake in cost of sales cost on the gross profit. If it is overstating gross profit, go and subtract it in the tax computation. If it is understating gross profit, go and add it back. Guys, hey, you are the last one. Yes. Okay. There is a question to do with interest deductibility under Section 25 of the Income Tax Act. We have 3 categories of interest that you need to be aware of as you get into this exam. Number 1 is normal bank interest. You're operating a bank and they are charging you, you got a loan to do your operations and they are charging you interest. That is a normal operating expense. But we also have a kind of interest that we call a capital expenditure. And technically we call it a borrowing cost. This kind of interest is when you go and borrow a loan to acquire or purchase or construct a qualifying asset. And the qualifying asset for accountants is an asset that takes substantial time to get ready for its intended use or sale. But basically speaking, we are talking about a capital asset. So if I go and borrow a loan and I'm constructing a building like this, the interest that I incur on that loan is a capital expenditure. And therefore that interest is not going to be an allowable deduction, but I'm going to add it on the cost of the building. And therefore give it capital deductions. I'm not going to expense that interest. The other interest that you must be aware of is when the group entities are lending to each other. I have gotten a loan from a parent, or the parent has gotten a loan from a subsidiary. That is going to be subjected to what we call interest capping. And interest capping simply means that whenever you see interest in the statement of profit or loss, and that interest is arising from the group lending or from the group companies, they are the ones that share the loans. You see whether that interest does not exceed the maximum cap. So the question is, how do you know the maximum cap and how do you calculate that maximum cap? And the moment you know the maximum cap, anything above the maximum cap becomes a non-allowable deduction as that interest. How do you get the interest cap? In the exam situation, you get the chargeable income. You add back the interest that was in the statement of profit or loss. You add back the tax depreciation, the one that you got from the wear and tear schedule. That combination will give you what we call the tax earnings before interest, tax depreciation, and amortization. That is the technical word of that total, of chargeable income plus interest plus the tax depreciation. It gives you the earnings before interest, tax, and depreciation and amortization. Calculate 30% of that total. Calculate 30% of that total. The figure you get becomes the maximum interest that you can claim. Anything beyond that 30% becomes a non-allowable deduction and you add it back. Guys, it's now 10:30. We're going to have a break of 10 minutes and we come back at 40 minutes past 10 and we proceed to the next. We'll now look at the other numbers. All of them require about 30 minutes. The biggest part was this part of income tax because it is going to be your compulsory number. And therefore you will need to pay particular attention to it. So when we come back, we'll look at other areas because we agreed today we are going to look at income tax from business. We are going to look at employment income, VAT, customs, partnership, rental income. So train yourself not to get tired because this is the only day I have to make sure that I talk about each of these. So have a break of 10 minutes and when we come back, we start from there. Okay, so shall we come back? Let's come back. We don't have a lot of time. We have so much to cover today. So let's come back. Tell your neighbors to come back.
You already have 100 people waiting.
They have shared the YouTube live stream. I see the numbers have extended beyond the limits, but those who cannot log in, please make sure you use the YouTube live stream. And whoever is in, please mute your microphone. They're also trying to expand the numbers on the Zoom link, but so far the limit has been we have gone beyond the limit. So if you are not able to log in, please, or your friends are not able to log in, please tell them that they have shared the YouTube live link and they can catch us on YouTube as well. Okay, so guys, let's come back and talk about employment income.
So the YouTube link was shared where?
On the groups. I don't know which groups you are. If you're not on any of the groups that they have shared the links, we can share with you the link where you are. Which groups are you? So I can share the links.
Thank you.
Whoever has seen the links, please share with your friends so that we are able to they're able to follow.
We're in the tax command center and tax
command center
and tax forum.
Okay, I can share it on the tax forum and you'll be able to see it. Or you can just inbox me and I will share it to you and you can circulate it wherever you want.
Can you do on medium taxpayers?
I also put it, okay, that's okay. But we also share, don't worry, we also share the YouTube recording. So whoever misses will definitely have an opportunity to share it. Okay, so ladies and gentlemen, another number that you can be probably 98% sure you will actually deal with is a number on employment income. And I want to highlight the key issues that you need to deal with, because I find the number of employment income really easy to deal with if you actually master what is taxable and what is not taxable. And there are very few things that are going to be exempt from employment income. All you need to know is that you will know that this is an employment income if you see a company employing an individual, because you cannot have any other person being in employment other than an individual. A company does not get into employment. So you're going to have a relationship where one company is employing an individual. And this company is going to be giving this individual so many things. These things are either going to be in cash form or in kind. But whatever you see the examiner telling you that this person was given this, it qualifies as employment income. Only that some of those employment incomes are exempt from tax and others are taxable. And we are looking to aggregate all those incomes that are taxable so that we get this person's total taxable income called chargeable income. And it's from that chargeable income that we are going to apply the individual income tax rates. Technically speaking, what we are calculating is pay as you earn, but it is called income tax. The mode of withholding that income tax from individuals who are earning employment income is what we call pay as as you earn. Now, in the exam situation, definitely they are going to give you a question which has a relationship of, they'll give you a question that looks like this, for example. This is a typical employment income question where they are actually describing the individual and all the things the individual is earning from the employment.
We're not seeing
from
the question.
The employment. Pardon?
You have not shared the question on your screen.
I haven't shared the question.
Yes, on your screen.
Okay, let me share it here. I thought you're seeing the screen. Can you see it now?
Yes.
Okay, what I was showing you is that you're going to see a typical question where there is an employer and an employee. And the question is going to be asking you, for example, this part B is what I'm interested in. Either calculate or advise Mr. Kunte on his chargeable employment income and the tax payable for the year 31st December 2023, or it could be for simply a month. You can deal with the number where they're asking you to calculate tax payable for either month or a year. And be careful. If they ask for a year, make sure that each item that is paid on a monthly basis, you multiply by 12. If they ask you for a month, it means it is a month. So no, am I dealing with pay as you earn for a month or for a year? But specifically talking is that you're going to have also to set up your answer, because the structure is also part of your passing. When I get an employment question, how do I structure my answer? If I were you, you need actually 3 columns. Column number 1, you need the description of the item. And each item they have given to you, whether it is taxable or exempt, it must surface in your answer. Do not leave out any item. Make sure that each item they have described, also you put it in your answer. And if it is exempt, just mention that it is exempt and don't put the figures in there. Others prefer to first indicate the figure and then indicate how much is taxable. But all we are looking for is the aggregate of the amount that is taxable. So at this point, you're going to look at all those things that are taxable and all those things that are exempt or not taxable. The things that are taxable, you will indicate the amount in the column where you're going to aggregate all the taxable things. The things that are exempt, you're going to indicate there 0, but you'll have indicated to the examiner that this item is exempt. But you'll get a mark for indicating that item and categorizing it as exempt. Now, we want to see all those items that we are saying are, let me expand this, because the most important columns are these. Column 1, column number 2, and column number 3. Those are the most important columns, because column number 1 is actually listing the items. Column number 2, you decide whether that item is taxable or exempt. And column number 3, you're going to actually put the amount that is taxable. You're saying this item is taxable and the amount that I'm going to tax is this. Because at the end of the day, you'll have a table that has both taxable items and exempt items. The other name of exempt is not taxable. And then what we are looking out for is to get what we call the total employment income that we are going to tax. And then from that total employment income, there is only one allowable deduction that you can consider for an employee, and that is local service tax. So whenever you see local service tax, after getting your total employment income, first you remove the local service tax before you can get the chargeable income where you're going to apply the tax rates. Now, when you get the chargeable income, that's when you go now to the last part of your question paper and see the individual income tax rates. At this point, we apply the individual income tax rates. In those income tax rates, we have rates for individuals who are resident and rates for individuals who are non-resident. Please note the rates you're applying. If a person is resident, you are going to apply the resident rates, because that table has, if you have looked at those tables, it has a column for chargeable income, but also has a column for the rate that you're going to apply. So it means if you get out of this table and you already have your chargeable income, all you have to ask yourself, where does this chargeable income fall in this table? And those are the rates you're going to apply. Now, I'm going to take a few minutes to highlight the things that are taxable and the things that are exempt, so that when you see the item, you automatically know that this should be part of your taxable items. And I will start with wages. Wages are taxable. Number 2, salaries. Salaries are taxable. Number 3, leave pay. Number 4, payment in lieu of leave. Payment in lieu of leave simply means you were supposed to take on your leave, you did not pay it, and they compensated you with some money. Overtime pay, those of you who work overtime, whenever they pay you overtime, it is part of your taxable employment income. Fees for work done. Some people receive fees instead of calling it salary, they call it fees. But as long as you received it from your employer, it becomes taxable. Next is commission, especially the marketeers. They give you the best pay, and then they also give you commission on top of what you have received as the best pay, especially to induce you to make more sales. So that commission becomes also part of your taxable income. Gratuity. Gratuity is also taxable income. So whenever you see gratuity, you know it is taxable income. Bonus. Some of you receive bonuses at the end of the year. You. Are we together? Next is entertainment allowance. Some of the MDs are given entertainment allowance because they know you're going to hang at Sheraton, you're going to hang at Serena. So they give you some entertainment allowance. That is a taxable allowance. Allowances for utilities. Some of you are very big in your companies that they even pay for your utilities at home, or they give you additional pay. Every month they add $1 million or 2 or 3 to match your utilities. That is taxable benefit. Allowances covering cost of living. If you incur any cost on your personal living, it is also taxable on you. Remember, we are saying anything moving from the employer to the employee, whatever description it is called employment income, but we are trying to see which of these items are taxable and which ones are not taxable. And your role is just to list them. At least if you miss everything else, don't miss listing them. Everything they have said the employer has given you, list it. Even if you don't know the treatment that is, list it. I don't want you to leave any item. As long as you see the employer giving the employee anything, just list it in your items. And then you start bargaining whether it is taxable or not taxable. Any housing allowance. Now, there is a difference between housing allowance and housing benefit. When they give you housing allowance, they have given you money as your housing allowance. Whether they give you 2 million and for you go and rent a house of 100,000, it is okay, but they have given you an allowance. That allowance is taxed without any calculation. It is different from a housing benefit. And I will tell you what a housing benefit is when I get to the benefits in kind. Here we are still talking about allowances, and we are talking about things that they are going to pay you in cash. All these that I've talked about are allowances, are things that you pay in cash. We have what we call medical allowance. Medical is in 3 parts. One of them is taxable and the other 2 parts are not taxable. So with medical, when they give you an allowance, it is taxable. But when they insure you, when they pay for your insurance, medical insurance, it is not taxable. Or when they refund, reimburse the medical expenses, you go to the hospital, you incur an expense and then bring the receipts to the employer. That is not taxable on you. So the only time we actually tax medical is when they have given you medical allowance. And then they say any other allowances. It simply means that every time they give you an allowance, every time they give you an allowance, here they are giving you money. Any allowance is taxable unless it is specifically excluded down here that you're going to see. So if you receive any allowance, the first thinking is this allowance is taxable. Then you ask, is there any exception to this general rule? Because any allowance is taxable. But are there any allowances that are not taxable? The answer is yes. And we are going to see those items. The fortunate bit is that the items that are not taxable, that are exempt, are very few. So if I was a person who crams, I first cram the ones that are exempt. And then the ones that the rest I know are going to be taxable. But let's get in. Now, Section 19, because employment income is coming from Section 19, it also says that any benefits in kind are also taxable. But the way we actually attach monetary values on the taxable benefits is that there is a specific schedule, Schedule 5, where you see how these benefits are going to be baptized with monetary values. Now, there are benefits that you cannot go to the exam without understanding, because you're very sure they will come. And I'm going to list some of the benefits that you're going to find in your exam. Number one is called a motor vehicle benefit. It's called a motor vehicle benefit. A motor vehicle benefit simply means you're an employee, but they have given you a motor vehicle. And whenever they give you a motor vehicle, it means this motor vehicle is available to you for both official and private use. If you're driving this vehicle to your home, if you're bringing back the vehicle, you're going to the market with it, you're taking your girlfriend out with the vehicle, your boyfriend outside with the vehicle, it means you're using it for also private purposes, and therefore there will be motor vehicle benefits. And I'll show you how we calculate that motor vehicle benefit. But the moment you see the motor vehicle, you just know the examiner wants you to calculate motor vehicle benefit. Next is provision of a housekeeper. Whenever they provide to you a housekeeper, you know there is a benefit. Next, provision of a chauffeur. We know where a chauffeur is, a driver. Now, I want you to imagine, if they gave you a vehicle, they gave you a driver, and they also give you fuel, it means you have three benefits. It means you have three benefits, because you have the motor vehicle benefit, you have the fuel benefit, and you also have the benefit for the driver, and there must be three. Provision of a gardener. Some of you have shamba boys at home, and they are being paid by the company. Provision of any other domestic assistant. Now, ladies and gentlemen, for each of these benefits that we are saying benefits in kind, we calculate them as follows. If, for example, they provided you the driver, the benefit is how much the employer is paying that driver on your behalf. And if you are contributing anything on that pay, then your contribution is reduced. For example, if your employer pays the driver 1 million per month, that is 12 in a year also, but you contribute, say, for example, 200,000 per month. It means for you have contributed 2.4. It means the benefit will be 12 minus 2.4. That will be the benefit taxable on you. So whatever benefit that you get, you reduce it with the employee contribution, if any. If they have contributed nothing, then definitely no. The next benefit is called provision of any meal, refreshment, or entertainment, not paying on equal term basis or not paying per diem or subsistence allowance. So if they give you meals at work, and these meals are given, probably they give you food, but the MD eats food of 100,000, the manager eats food of 60,000, and the officers eat food of 20,000, you all become taxable because you have violated the law. The law says it is only going to be exempt if it is provided to all employees on equal term basis. So if it is provided to you, but it is not on equal term basis, then we tax it. Next one is provision of utilities in respect of the employee's place of residence. They are paying for your electricity, they are paying for your power, rather for your water, they are paying for your garbage collection, they are paying for any utilities at home. That payment that has been made by the employer is taxable on you as your benefit. Now, another common benefit is the provision of loans. If your employer gives you a loan that is above 1 million, and he has given it to you at an interest rate less than the Bank of Uganda or statutory rates, we say you have a benefit on that loan. And I'm going to show you how you calculate the loan benefits. I actually want you to be cautious with these three benefits: motor vehicle benefits, housing benefits, and loan benefits. You cannot miss at least one of them, if not all of them. Pardon? I'm coming to that. The next one is waiver of an employer of an obligation of the employee to pay or repay employer's debt. An example, the employer has given you a loan, and this happened so much in COVID. The employer had given you a loan, he knows now you're struggling, he says, you know, I have forgiven you the loan. I am going to waive off the loan. That amount that he has waived off becomes your employment income that is taxable. Next is transfer or use of property or provision of services to the employee. This time, the employer has said, Julius, this computer I've given to you for taking. There is a motor vehicle here, we are giving it to you. We look at the value of that asset and it becomes the taxable benefit on you. The next one is what I emphasized as provision of accommodation or housing. This is what we call a housing benefit. Ladies and gentlemen, a housing benefit is when either you have been given a house or they are paying rent for you. I told you with the housing, we have three categories. Where they give you allowance, that is automatically taxable, no calculation. Two is when they have given you a house, you must go through some calculation. Or when they are paying for your rent, you must also go through some calculation. Because when they pay you your rent, when they pay for your rent, or they have given you a house, we call that a housing benefit. And the moment it is a housing benefit, it is one of the benefits, it is one of the benefits that you're going to calculate last. You will calculate the housing benefit last. Why? Because it uses ingredients of other benefits, and I will show you why. The next item is provision of any other benefit not being exempt. So if you get any other benefit and it is not among the exempt items that I'm going to show you, then that benefit, whether it is described by how, as long as you know that the employer has provided the benefit to the employee, that benefit becomes taxable irrespective of how it has been described. The other benefit that is taxable on you, I already said, no, I hadn't said this. Discharge or reimbursement of employee private expenses. I normally use an example: you go to the bar, drink yourself silly, and then exceed your bill. You had gone with $1 million, and you have, you know, the guys know it. When they say like this, you know that is a round. So you have given your friends rounds, and before you get to know, they have given you a bill of 2.5 million. But in your pocket, you only have 200. So if you call your employer and your employer has discharged that bill, then it is a taxable benefit on you because it is a private expense. Compensation for the termination of any contract of employment. Have you heard about terminal benefits? Terminal benefits are taxable, but I want you to be cautious with terminal benefits. If this employee has been working with the same employer for at least 10 years or more, 10 years or more, we are not going to tax 100% of these benefits. We are only going to tax 75%. In other words, if I receive terminal benefits of 100 million, and I have been working for more than 10 years with this employer, it means in my taxable income, there will be 75 million, and in my exempt income, there will be 25 million. Because we want to reward those who are working with the same employers for a long time. And long time is defined as 10 years or more. Hey, what has happened? Time and long time is defined as 10 years or more. Okay. So proceed. Next is life insurance premiums paid by a tax-exempt employer. Listen properly on this. It has two faces. Life insurance premiums have two faces. Sometimes it is taxable, sometimes it is exempt. When is it taxable? When is it exempt? It is taxable on the employee when your employer is tax exempt. If your employer has an income tax exemption, if he pays your life insurance premiums, we tax it on you. If your employer is a tax-paying entity, then that life insurance becomes exempt. Now, watch the exam. If I am in the exam and the first statement, the examiner is telling me that this employer is tax exempt, you know they are testing you on life insurance. And at that point, that life insurance premium is going to be taxed on the employee. And that's the only time when they actually say the employer is exempt. So when they say it, you know they are testing you on life insurance. I hope that is enough tip. Next is payments or consideration for employees' agreements to any conditions or change in conditions of employment. Now this one has so many names. Some of you call it hardship allowance. Others call it when they send you up counter, they give you what? What other name does it have? For us, we call it hardship allowance. If they send you, for example, in a hard to reach area, a hard disturbance allowance, that's another name. When they give you an additional compensation, because probably you have gone into a hardship place, you've gone into a place that is hard to reach, then that compensation becomes part of your taxable incomes. The next one also has three faces. The next one has three faces, and it's about shares. It's about a share acquisition scheme. Employers usually give employees an opportunity to become shareholders in companies, especially if they are strategic employees. And this is how they do it. Number one, they can give you shares, but at the market value. There is no benefit because you're acting like any other person who has bought shares. But if they give you shares at a value less than the fair market value of that share, then there is a benefit of the difference. The share at the company was 200 shillings, but they have given it to you at 150. It means the 50 is a benefit times the number of shares they have given you. That is scenario number one. Scenario number two is when they give you what we call share options or rights. Share options simply means this time they are not giving you shares, but they are giving you a promise that when you fulfill certain conditions, you will become a shareholder. That is a share option. Now, that share option does not carry taxable benefit. So by giving you just share options or rights, there is no taxable benefit, it is exempt. The value of those benefits, of those rights is exempt. But if you go ahead and dispose of those rights, those options to someone else for a gain, then that gain becomes a taxable benefit. So 3 things on shares or share acquisition scheme. Number 1, they have given you shares, but at a lower value than the fair market price. There is a benefit, taxable benefit. Number 2, they have given you share options or rights. That is exempt. Number 3, if the share options they have given you, gone ahead and dispose them for a gain, that gain becomes a taxable benefit. I hope we are together. So that's what I was explaining. Now, I want us to go to the 8 items. We have 8 items that are going to earn you a mark by only listing the item and telling the examiner that it is exempt. So you don't have to calculate anything. All the examiner is waiting for is identify that this item is exempt, put it in your answer, and then on the figures put 0. But make sure that you indicate it that is exempt. How many items are these? There are only 8 items. Only 8. So I told you, you had better grab those 8 items because they give you a free mark. Okay, so number 1, and I will show you how it is usually examined. Number 1 is called the cost of passage to and in Uganda and from Uganda in respect of employee's appointment or termination of employment. The moment you're doing a number and you see that they are employing an expatriate, the moment you're doing a number and they are saying they are employing an expatriate, you just know they are likely to test you on passage costs, because passage cost simply means relocation costs. Someone was employed from, say for example, outside Uganda, but you have to transfer him with his family to Uganda. So you're going to incur his air tickets, you're going to incur any relocation costs related with his shifting to Uganda is not a taxable benefit on him. And when he is done with his employment, the day he is leaving and you also incur costs of transporting him back to his country is also called the passage cost or relocation cost, and it is not taxable, it is exempt. However, if you bring this person and during the year he travels within the year and you're still paying for his costs, those are taxable on him. Passage is when you're coming in and when you're finally leaving. Any middle travels, if they pay for those middle travels, they become taxable. Number 2, reimbursement or discharge of employees' medical expense, including premium or other amount paid for medical insurance. I had already talked about that. When they pay for your medical insurance and your family, it is not a taxable benefit. When they reimburse your medical expenses, it is not a taxable benefit. Number 3, I have already talked about that. Life insurance premiums other than those paid by tax-exempt employers. It means if you're an employer is a normal tax-paying employer, life insurance premiums are going to be exempt in your hands. Next one is per diems, what we call allowances for accommodation, travel expenses, meals and refreshments, while undertaking travel in the performance of employment activities. All of you, some of you are working, you go to the field. When they give you those allowances for accommodation, for meals, for refreshments, they are not taxed on you because it is allowed by the law as exempt income. Next one is meals or refreshments, all full-time employees on equal terms. You have a cafeteria at work where you all go in the same dining hall and they serve you food. That is not a taxable benefit. But the moment they give you an allowance, you're finished. They will tax you on it. So it's different. Next is any benefit that is less than 10,000 per month. So if they tell you that you received, for example, airtime of 8,000, even if you receive it for 12 months, we are not going to tax it because on a monthly basis, it is less than 10,000. So any benefit that is less than 10,000, whether it is a gift or what, is not going to be taxed on you. Next, contribution or similar payment by the employer made to retirement funds. And here we are referring to the 10% contribution. You know, on your salary, the employer usually adds 10% to contribute to NSSF. That is not taxable on you, including any provident funds that you have. Some of you have other retirement funds. Those contributions to the retirement funds are not taxable benefits. The value of a right or option to acquire shares granted to an employee under an employee share acquisition scheme, I had already talked about that. So those are the items in the employment income that you're going to be dealing with. All you need to make sure is identify the items that are taxable and the items that are not taxable. Now, I want to make mention about specific things that you must remember in that exam. Number one, don't enter into that exam without knowing how to use the tables. Without knowing how to use the income tax rates for individuals. Think of a number, go to the table and say, this is the chargeable income. How do I calculate the tax? I don't want you to try the first time in the exam because you want to get it right. Especially the last band where you have the lower rate and the higher, the extra tax. Make sure you get your chargeable income and practice it. Number two that I want to emphasize in employment income is the calculation of motor vehicle benefit. The formula is very simple. 20% times A times B over C. Close the brackets. And then you remove D. Your strength is knowing how much to attach to each of those letters. Because 20% is constant, you're not going to change that. But A is the market value of the vehicle at the date it is first provided to you. Now, cheat for you exams, A is the net book value of the vehicle. And why do I say is the net book value of the vehicle? If they give you this vehicle for the first time when it is new, A is that the cost which has been incurred in purchasing that vehicle. If you use it for more than 1 year, the next year, they must depreciate that vehicle because the value is no longer the same. If you're an employee, but you get this vehicle after someone has already used it, it must be depreciated until the date when they give it to you for the first time. So you depreciate it until the first day of the year. Don't depreciate it until the end of the year. You depreciate it until the first day of the year. If I am talking about the year 2024, and the car was purchased in 2022, I depreciate it until the end of 2023 because I am calculating for 2024. The year when you are calculating, you don't include the depreciation. And the reason I'm emphasizing that is because some students have been depreciating, even including the year they are actually calculating the motor vehicle benefit. You don't calculate the depreciation in the year when you're calculating the motor vehicle benefit. So what is the formula? The formula for calculating the net book value is that you depreciate that vehicle at the rate of 35% on a reducing balance basis. Now, I want you to forget about your wear and tear schedule. This motor vehicle is not in the wear and tear schedule because I have had confusion. They know that motor vehicles in the wear and tear schedule take 20%. And then they want to use that 20% to calculate also. This is section 19, where Antea is under section 27, different law. So the motor vehicle benefits, if you're looking for A and you want to depreciate that vehicle, you depreciate it at 35% on a reducing balance basis. And the shortcut is simple. If this vehicle had been used for 1 year, multiply the cost by 0.65. That is a shortcut. If it has been used for 2 years, multiply the cost by 0.65, multiply by 6.05. Rather 0.65, 2 times. I am trying to save your time. Because if you're going to calculate it on a reducing balance basis, the long way is I get the cost, I apply 35%. That 35% gives me depreciation. I have to go back to the cost and first remove depreciation to get to the net book value. If I am going to get to the second year, I first look for the net book value, apply again 35% to get to the depreciation for that year, and then I have to go back and remove it from the net book value to get the net book value in the second year. Someone who's sharp enough says if depreciation is 35%, it means net book value is 65%. So if I go to the cost and multiply by 65%, I immediately get to the net book value. If I want to do it 2 times, I actually get to the cost times 0.65 times 0.65. I have depreciated it for 2 years, and the result will be the net book value. I don't have to go through the removing of depreciation to get to the net book value. You choose. If you can actually remember the shortcut, the better for you. All you're looking for is A. A is the net book value. If the vehicle you're the first user and it is the first year of it, the cost becomes A. If you're using it and it is the second year, depreciate it for 1 year. If it is the third year, depreciate it for 2 years. If you are a new MD and you're picking it from one other MD who has used it for 2 years, first depreciate the cost by 2 years on a reducing balance basis. I hope that is clear. And on 35%. That is A. The next one is B. Ideally, B is 365 days. However, the examiner will tell you that some days this vehicle was not available to the employee. If they gave you this vehicle and you went home and packed it and used it whatever you want, B still stands at 365. So we assume that even if you're using it for official use, it is going to be available 365 days. But be careful, the examiner could tell you when this vehicle was not available to the employee. For example, he could say, in the month of December, this employee takes his leave and the vehicle is parked at the office premises. He's simply telling you, out of the 365, this vehicle is only available for 300 and what is 365 minus 31 days? Because it is not only available, it is only not available for only 31 days of December. That's when it is packed. But the rest of the days was available. Remember, B is the number of days it is available for private use. And I have said, it is assumed that it is available 365 days. What does that mean? That if the examiner is silent, please take B to be 365 days. If the examiner has told you the specific days when it is not available, then remove those days from 365 days to get your B. If they say this vehicle is not available over the weekend, how many weekends do we have in a year? How many weekend days do we have in a year?
52.
We have 52 weeks in a year, meaning we have 104 weekend days in a year. So if they tell you it is not available over the weekend, get 104, remove it from 365. You'll be getting your B. If the examiner is silent, your B is 365. If the examiner tells you this vehicle is completely used for official use, there is no benefit. Are we together? That is your B. Your C is constant. It is 365 days. Your D is what the employee has contributed. Most of the times when you're getting this vehicle, they tell you the employee contributes, say for example, 500,000 per month. So means your D will be 6 million. So apply the numbers, 20% times A times B over C minus D. Remember, D is outside the bracket. Okay, let's move. The next benefit that I want to emphasize before I conclude is housing benefit. What I want to emphasize is housing benefit must be calculated last. Must be calculated last. Why? Because of its calculation. In the calculation of housing benefits, you have two items. You have A and you have B. But at the end of the day, you compare A and B and choose which one is the lower of the two. So how do you calculate A? They will give you what we call the market rate. They will give you what we call the market rent. If they are paying rent for you, they will tell you each month we pay 2 million. It means the market rent will be 2 times 24. If they have given a house, they will tell you what the market rent of that house is. Now, A is the annual market rent minus the employee's contribution. So if the market rent, monthly market rent is 2 million, it means my A is going to be 2 times 12. Then I remove what the employee has contributed, if any. They could be paying for you 2 million, but the employee contributes 500,000. It simply means it will be 2 million times 12, that is 24, then minus 500 times 12. That becomes 18. Not so. That is your A. Do you have any problem with A? Okay, we go to B. B is the one that causes confusion to students. But this is how B is calculated. You get 15%, multiply open brackets. And the reason why I'm actually being so detailed like that is because I want you to do the mathematics well. So you get 15% into brackets. The employment income, this figure that you calculated here, this total, where you say this total is taxable income, that employment income. Don't write it there as yet if you know that you're going to calculate but rather housing benefit. Get this figure, first add the figure you calculated in the A. So get this employment income, which you have in your table, where you have put all the benefits and you satisfied all the benefits have been dealt with. The only benefit you haven't brought there is housing benefit. So that's total of employment income. Bring it and first add the result of A, what you calculated in A. That will give you a figure where you're going to multiply 15%. So the 15% is multiplied on a combination of those two figures. What are those two figures? The amount of employment income you have picked from the table, the total, plus the figure you have calculated in A. Once you aggregate them, apply 15%. That will give you the value of B. And then now compare A and B. Whichever is the lower becomes your housing benefits. And then you can go back to your calculation and put your housing benefits and re-aggregate your employment income. Okay. Finally, in here, I want to talk about security guards. Security guards comes all the time but it is not a taxable benefit. I haven't talked about it in the list of section 19 because that is an exceptional item in practice note of 2001. And they examine it more often. So when you see security guards, you just say this is an exempt income. The other item lastly is boys' quarters. When you see boys' quarters, they are not taxable items because they do not have a market rate on their own. I now entertain the questions or any question on employment income before I switch. Oh, I didn't show you the calculation of loans. This is how we do the calculation of loans. Thank you for reminding me. With loans, the conditions are like three. Number one condition, the loan must be above 1 million. If it is below 1 million, there is no benefit. So meaning the loan must be above 1 million. Number two, that loan must have been acquired from your employer at an interest rate less than the statutory rate. Now, please look for the statutory rate. They are going to give it to you. Sometimes they give it to you at the end of the question paper. Sometimes they give it to you in the question itself. So please look for it. I don't want you to look at the ceiling and say, in this question, they did not give us the certificate. They will give it to you. And if you look for it and you can't find it, please raise up your hand and say, I don't see the statutory rate. But the benefit is calculated as getting the statutory rate minus the rate at which they have given you the loan. Because that is what the benefit is. Assume the statutory rate is 10%, but they give you a loan at 6%. The benefit is that they have given you a benefit of 4%. So apply that 4% on the loan amount, and you have your loan benefit. Now, sometimes the examiner wants to confuse you. They give you the statutory rate at the beginning of the year, commencement of the year, and also the statutory rate at the end of the year. You use the statutory rate at the beginning of the year because you're calculating for a benefit for the whole year. Now, last warning. For all those benefits that we are calculating, the loan benefits, the motor vehicle benefits, those are annual benefits. It means when you're dealing with a number on a monthly basis, you first calculate that benefit as if it's an annual benefit and then divide by 12. Because those percentages represent annual rates. So you first calculate as if it is annual and then divide by 12. We are going to use strictly 5 minutes to attend to any question on employment income before we can switch. Yes. Yes. For the motor vehicle benefit, you bought the motor vehicle in 2020. At how much? 100 million. You bought it when? In 2020. The company bought it in 2020. And they give it to you in 2020. No depreciation. Has it depreciated? No. Because you only look for the net book value if that vehicle is given to you after at least 1 year from the time it was purchased. If they give it to you in a period when it was purchased, then you cannot depreciate it. The A becomes that cost. How together? Because you're depreciating after 1 year. You don't depreciate within the same year. Yes. Yes. Pardon? The passage cost. Passage cost simply means, and it is only applicable to expatriates. We can only talk about passage costs if the person that has been employed has been picked from outside Uganda. And we are saying, me as an employer, I am employing someone outside Uganda. I must relocate him to Uganda. And when I am relocating him with his family, I am going to incur costs on him. for example, air tickets, and other related relocation costs. And we're saying the time when I am bringing him for the first time and the time when finally his employment contract ends, I have to take him back. Those costs that I incur on his behalf, air tickets and whatever, they are not taxed on him. They are taken as exempt income. Whereas it is the benefit to him, but it is not a taxable benefit. Altogether. And I told you that they will also trick you. They can tell you there are those costs, but also they have been giving him, they have been paying for his air tickets to go back for a holiday, check on his family. Those middle other costs are taxable on him because they don't confine to the passage costs. Yes.
Excuse me, sir.
Just a second. I'm coming to you on online. I'm going to open the online platform. Just a second. I'm still attending the physical class. I'll come back to you. Yes. A flight ticket to go for training. Ladies and gentlemen, we said that any costs that are incurred by the employer in the normal course of travel, in the performance of employment, is not taxed on the employee because you're not doing training for yourself. You're doing training on the job. Yes. Speak louder, a little louder. Housing benefit is the same as accommodation benefit, but it is different from housing allowance. Housing allowance, they have given you money. Housing or accommodation benefit is when they are paying rent for you or they have given you a house. So if they are paying rent for you or they have given you a house, that's when you have to go through that calculation that we talked about of A and B. And then you compare A and B and get the lower of the two. The lower of the two becomes your housing benefit and take it to your table. Yes, one question in the physical class and then we come to the online class. Yes. How will ghosts, security guards, security cameras? No, security cameras is a benefit because the law specifically talks about security guards. So I do not want to actually say security cameras are the same as security guards. Yes. You see, you cannot impute what is not in the law. The law has said security guards. So if they give you security cameras, then it is a benefit because the security guard is not a security camera. Guys online, please ask your question in the next 2 minutes.
Mine is about entertainment. In case the examiner is silent and it just says entertainment and he gives you a figure, do we exempt or we tax?
The moment the examiner says entertainment and he has not added anything, please tax it.
Okay.
We have said entertainment is generally a taxable benefit. It will only jump out of the taxable brackets when they have added information to it. And the information they will add to it is that either this is accommodation, meals, and allowance while undertaking travel in the performance of your employment, or these are meals and refreshments provided to all full-time employees on equal term basis, or that it has been included in your no. For here, we are now testing whether it is subsistence allowance or it is on equal term basis.
Good morning, sir.
How are you, sir?
I'm okay. I have a quick one about gratuity. About gratuity. Yes. When an employer has been employed for over a period of 10 years,
that's not gratuity. That's not gratuity. That's not gratuity. Those are terminal benefits. Terminal benefits and gratuity are different. Okay. It is when you have been paid terminal benefits that we think about your number of years of service. For terminal benefits, we said if you have 10 years or more, we are only going to tax 75% and 25% is going to be exempt.
Great, thank you.
Okay, guys, we need to switch now.
What about?
We need to switch. I know you have so many questions, but let's switch.
Excuse me, sir.
Yes, you're excused.
Yeah, mine is about share options. Can you highlight more about, maybe give an example?
I give an example of share options.
Yeah, an incidence. Like.
Okay. An example of a share option is you sit down with your MD because you know he's very good and you want to retain him, and agree that if he's, for example, stays with you for the next 5 years, you're going to give him a chance to buy 2 shares of the company. That's called a share option.
Thank you.
And in accounting, we call it a financial instrument.
Okay.
And accounting for it is provided for under IFRS 2, share-based payments.
Okay.
Okay.
So what if they say they?
Pardon?
On our benefits, you said when we're calculating benefits and they give us monthly, we treat.
Please speak louder. Get closer to your microphone.
Am I louder now?
Pardon?
I'm saying, when they give us benefits and they are monthly.
Yes.
Hello? When they
yes,
give us
I can hear you.
We divide by 12, not multiply by 12.
If they give you any amount on a monthly basis and you're dealing with an annual number and you're calculating tax for the whole year, you must multiply by 12 for any item paid on a monthly basis. If they ask you for a number and it is on a monthly basis, items that have percentages like motor vehicle benefits, like loan benefits, it means that percentage represents annual. So once you calculate for the annual benefit, you divide by 12 to get the monthly benefit.
Okay, thank you.
Okay, guys, we are leaving employment income. We are now going to VAT, value added tax.
A last one, please.
The last one.
On the passage cost, yes, on the passage cost, in case they are splitted, they give you the amount for the expatriate, and they give you the amount of his family, maybe the children and the wife. Do we aggregate the amount, or we just take for the expatriate only?
All of them will be aggregated.
Oh, thank you.
Okay. So guys, take a breath, and come back to me,
Council.
I hope you're not asking about employment income.
Council, there is something you've forgotten, sir.
Which one is that?
About a loan. There are scenarios where they tell you that a loan is payable in 4 months. How do you handle that?
I told you that interest rate is annual. So if it is payable in 4 months, they are telling you prorate it. Multiply by 4 out of 12.
How are we going to prorate?
Get that benefit as if it is annual. Afterwards, multiply by 4 out of 12.
Okay, thank you, sir.
You're welcome. Okay, guys, let's come back to me first adding some fuel. Do you see yourselves passing?
Hello.
If you don't get 50% really, then you have a problem. We actually need to get a serious doctor for you, because this that I'm giving you are the answers. Now imagine even if you actually went into the exam and said, I am only going to listen to Julius's voice and write, you'll still get it right. Because we're only talking about answers now. You only have to remember them. Yes.
Hello.
How the loan benefit, if at all you're given a rate at the commencement of the year of income and at the end of year of income, which one do you consider to be the
I have already
CBR?
answered that, but I will answer it for you for the last time. You consider the commencement date interest rate. Please keep in class, don't get out of class, because I have made sure that all those questions have been answered. So you must be in class to be able to listen to them. Okay, guys, again, there is over 98% chance that you're going to deal with the number on VAT. You'll have a number on VAT. So you had better prepare for it. But what do you need for VAT? Now, I want to show you all that you need to calculate VAT. This is all that you need. Where is my formula? My formula is there. Hey, I need to remove the colors so that you're able to see them. So let me first remove these colors so that you're able to see these items. Now, if you do any answer and you don't find yourself with this formula, just know you didn't get it right. The VAT, first of all, they are going to ask you for VAT payable or claimable. VAT payable or claimable. But there are so many other nitty-gritties that you're going to deal with for you to be able to get the VAT payable or claimable. And those are the issues I want to emphasize. So number one, for you to get the VAT payable or claimable, you need what we call output VAT. You need output VAT. And simply say, output VAT is VAT on sales. As long as they have told you that these are sales, your role is to calculate output VAT. The next thing you remove is input VAT allowed. Input VAT. Ladies and gentlemen, input VAT is on purchases and administrative expenses. So whatever VAT they charged you on your purchases and your expenses is called input VAT. Whatever VAT you charged on your sales is called output VAT. Ideally, if there were no any adjustment, VAT would be as simple as getting output VAT minus input VAT. But definitely, you're going to deal with some other adjustments, and those are the ones that I want to emphasize. Now, when you get output VAT minus input VAT, we said you're getting your first VAT payable or claimable. It is payable if it is positive, claimable if it is negative. The other word of claimable is refundable. Please mute your microphone, Mr. Chubuka. The other word of claimable is refundable. What does that mean? That every time you get a negative, it is your right to refund you. It simply means you're still claiming more money from your because you incurred more input than the output you have generated. And it happens in business. I go purchase a lot in that month, but I have sold less. So I still have stock. So I'm likely to have less output, but I have more input because I incurred more input. So once you have a negative, it means you are in a claimable position. And for that month, you choose, do I want to ask for a refund? Do I want to carry it forward in the next period? When you carry it forward in the next period, we call it an offset. In the next period, you'll be claiming it as an offset. When you ask for a refund, then we take you through the review process and refund you that money. Process it in terms of cash and give it to you because your input is more than output. Now, every time you're doing a calculation, after comparing output and input, the next question you ask, if this is the VAT that I am supposed to pay, for example, called VAT payable, do I have any claim from the previous period? What we are calling the VAT offset. And that is a free mark because the examiner is going to give you that offset. All you need is to know where to place it. Once you've removed the offset, there are other two adjustments that you can make. We now have what we call VAT withholding. We now have what we call VAT withholding. And this is how it works. You as the business person, you can withhold from others, but they can also withhold from you. If the person you're dealing with, if the number you're dealing with, they tell you that he is a designated withholding agent, it simply means that he will be withholding from his suppliers because he withhold from those he's going to pay. And who is he paying? He's paying his suppliers. Who is likely to withhold from him? His customers. Because when his customers buy from him, as they are paying him, they are likely to withhold from him if he's not exempted from withholding tax. So how do we make those adjustments? If he is the one withholding, it means he's withholding on behalf of government and he must bring it. That's why we add it as a positive. So VAT withheld from suppliers is a positive. He's the one declaring it. But VAT withheld from him gives him a withholding credit in terms of VAT, and therefore it reduces his liability. That's why whenever they tell you that he has any unutilized VAT credits, it means someone withheld from him, and it is now time for him to use them to reduce his tax liability. If they tell you that he withheld from others, it means it is time for him to declare QRA. Hence this formula. Output VAT less input VAT gives us the first line of VAT payable or claimable. And then we make the adjustments. What are the adjustments? We remove any VAT offset carried forward from the previous period. We remove any VAT that they are withheld from him, what we are calling withholding VAT. But we add what he has withheld from others, because whatever he has withheld from others, he must declare it URA. Whatever they have withheld from him, he claims it from URA. And then we'll have our next VAT payable or claim. Now, what I am going to do is only to break down each of these ingredients to put on some light. When I'm talking about output VAT, what do you expect to see? When I'm talking about input VAT, what are the things you must prepare for? When I'm talking about withholding tax, what are the things you must prepare for in the exam? But this is the formula that you need. Make sure that your answer has this formula. Output VAT, less input VAT, it gives you VAT payable, claimable. You remove the offset, you add back what he withheld from others, and then you less what they withheld from him, and you'll have your VAT payable or claimable. Now, I'm going to break each one of them. I am going to start with the output VAT. Ladies and gentlemen, we said that output VAT is strictly from sales. You have made sales. Now, the sales that you have made are going to be basically categorized like this. Any sale that they describe for you, it is either going to be standard rated, it is going to be zero rated, it is going to be exempt, it is going to be deemed. I repeat, it is either going to be standard rated, it is going to be zero rated, it is going to be exempt, or sometimes with special regime, it is going to be deemed. And I will explain each of them. When they say something is standard rated, it means it attracts VAT at 18%. When they say something is zero rated, it means it attracts VAT, but at 0%. When they say something is exempt, it means it does not attract any VAT. When they say something is deemed, it means that it is a supply to a donor-funded project. So if they tell you this was the donor-funded project, then you know the examiner is testing you on deemed VAT, or it is a supply to the licensee of petroleum licenses. So we have a special provision called deemed. In case you see it in exam, don't get worried. But largely speaking, there are 3 categories: standard rated, 0 rated, and exempt. Now, both standard rated and 0 rated are called taxable supplies. Both 0 rated and standard rated are called taxable supplies. Means that, broadly speaking, we only have 2 supplies: taxable or exempt supplies. But when we break the taxable, they are either standard rated or 0 rated. Now, why am I emphasizing this? The examiner is going to give you a list of what you sold. And you must be able to say that this item is standard rated, 0 rated, or exempt. The moment you say standard rated, there must be another question you ask yourself for you to be able to get VAT. Was the amount inclusive or exclusive? Now, you will see statements like when they say sales as the heading, in brackets, amounts inclusive of VAT where applicable, or amounts exclusive of VAT where applicable. All they are saying is that when you say something is standard rated, then you ask yourself, was the amount inclusive or exclusive, for you to be able to know what rate to apply to get the output VAT. Now, when they say sales are exclusive of VAT, to get the VAT amount on any item that is standard rated, you multiply the amount by 18%. If it is 100,000, 100,000 times 18 out of 100. That is 18%, or simply 18%. When they say something is inclusive, when the amount is inclusive, for you to get the VAT components, you multiply that amount by 18 out of 118. And we call that the VAT fraction. So 18% is called the VAT rate. 18 out of 118 is called the VAT fraction. That simply means that if you have the inclusive amount, you multiply by the VAT fraction. If you have the exclusive amount, you multiply by the VAT rate. VAT rate is 18%, VAT fraction is 18 out of 118. I hope to do one more. But that rate of fraction is only applicable on standard rated items. If they are 0 rated, you multiply by 0% and the result is 0. If they are exempt, you multiply by nothing and the result is nothing. But you must indicate that you have done that because they want to give you a mark. That's why for each item that they're going to give you, you have a column. You're going to have a column. You are going to have a column for the description of the item. You have a column where you're deciding whether it is standard rated, 0 rated, or exempt. And then you have an amount, and that amount you're going to indicate whether it is inclusive or exclusive, so that you can be able to have a column for the VAT rate or VAT fraction. So that when you get the amount and multiply by the rate of fraction, you're able to get the VAT amount because that's what you're looking for. An example, if I have an item called sugar, and the amount is inclusive of VAT. First of all, in the first column, I will say sugar. Second column, I say it is standard rated. Third column, I will say amount exclusive of VAT, 100,000. Then I will say VAT rate 18, and then I will go ahead to calculate the VAT amount as 18,000. That will be my output VAT. If it is inclusive, I multiply the amount by 118. The question is, what is then, how are you going to know what is exempt, what is standard rated, what is zero rated? Unfortunately, this is when you have to have a sharp mind to cram. You must be able to cram these things. I am only going to use a few minutes to run through, because the only lists that we have a schedule for exempt supplies, and we have a schedule for zero rated supplies. We don't have a schedule for standard rated. And the assumption is whatever is not zero rated and exempt, then it is standard rated. But I have labeled, pick the most recurring items as standard rated, and therefore have picked examples of those that you're going to find under standard rated. And then it will be easier for you to know that it is standard rated. So I'm going to highlight some of the examples of standard rated, and then I will show you the list of zero rated and the list of exempt, so that whenever you see them, you'll be able to share them. Now, when you look at these items that I have actually named as standard rated supplies, first of all, I'm indicating that we don't have a schedule for standard rated. So these items that I'm listing here are not exhaustive. What is exhaustive is the list of zero rated and the list of exempt, but the list of standard rated is not exhaustive. But what are some of these examples of standard rated? Number one, supply of sugar, supply of wheat flour, or even wheat grain, supply of clothing, supply of rent, supply of security services, sale of a capital asset. If you sell any capital asset, whether motor vehicle, whether building, that is taxable. Supply of professional services. Imported services, we have what we call VAT on imported services. Supply of packaging materials. Supply of goods for own use. Supply of mobile phones. Supply of cooking oil. Supply of computers and data handling equipment. Supply, sale by auctioning. Diapers, now diapers have become standard rated. For a long time, they were actually exempt. Now they are standard rated. Cotton seed cake. All production inputs into iron ore smelting into billets. Sale by auction included as a supply for goods. Taxable supplies that are gifted or donated to employees by employers. The supply of postage stamps. The supply of software and equipment installation services to manufacturers. The supply of services incidental to medical services and royalties paid in respect of agricultural technologies. The supply of goods and services to the contractors and subcontractors of hydropower, hydroelectric power, solar power, geothermal power, or biogas, and wind energy projects for personal and domestic use. The key word there is for personal and domestic use. Why? Because they also have an exemption. If you actually purchase any other item that are going to be used on the project, they are exempt. But if you're buying them for personal and domestic use, then they become standard rated. These items are not exhaustive. But if you have been practicing, you will see that most of the items that have been considered as standard rated are actually here. Now, I don't want you to take this list of standard rated as very serious, but the one of zero rated and the one of exempt must be taken seriously, because that's where you are going to find numbers. The good thing is the list of zero rated items is very, very small as well. And I also tell you the trick of identifying something that is exempt. So that when you're doing quick ponki and you're not sure whether you should exempt it or not, the good thing is that when you actually confuse zero rated and exempt, you miss a mark, but it does not interrupt with your calculation. Because all VAT, all exempt and zero rated are going to have zero at the end of the day as VAT, meaning it does not affect your numbers. But of course, you miss a mark if you call something exempt yet it is zero rated. So quickly, I am going to, just for your purposes and for you to remember, I'm going to run through the zero rated supplies and then the exempt supplies, and then I will be able to show you the adjustments that you need. Number one, supply of goods or I'm now looking at zero rated supplies. Supply of goods or services where the goods or services are exported from Uganda as part of the supply. What does that mean? Every time you see an export, it automatically becomes zero rated. I'm now emphasizing the general rule that when you see anything that has been exported, it becomes zero rated. Supply of international transport of goods or passengers and tickets for their transport, because again it is international, we are crossing borders, it is zero rated. Supply of drugs, medicines and medical sundries manufactured in Uganda. Now there are two marks here that you must get. When we manufacture these medicines in Uganda, they become zero rated. When we import them, they become exempt. Supply of educational materials. This is where everyone wants to. I have also picked what educational materials are, because not everything on NASA Road is an educational material. So, supply of educational materials is zero rated. Supply of seeds, fertilizers, pesticides, and hose, zero rated. Supply of sanitary towels, menstrual cups, and tampons and inputs for their manufacture. That is very common. If you practice numbers of VAT, you see that one of these items will come. Sanitary towels, menstrual cups, or tampons, and inputs for their manufacture, zero rated. Supply of leased aircraft, aircraft engines, spare parts of aircraft, aircraft maintenance, and equipment and repair services, zero rated. Supply of cereals, where the cereals are grown and milled in Uganda. That means if you import them, they become standard rated. Now, they are zero rated because they are grown and milled in Uganda. Supply of handling services provided by national medical stores in respect of medicines and other medical supplies funded by donors. Those are zero rated. Definitely, I am not going to go through the exempt supplies because I'm going to share with you this. So you go through the exempt supplies. All I'm saying is that you must be able to remember the zero rated supplies, the exempt supplies, for you to be able to get the standard rated supplies. But once you have the standard rated supplies, know whether they are inclusive or exclusive to be able to know whether to apply the rate or the fraction. Now, I want specifically to go to input because we have many marks under input. There are many adjustments under input, and that's what I want to actually emphasize. When you go to input, we say the input is picked from your purchases and administrative expenses. But I want you to be cautious of certain items where even when you have incurred VAT, you're not going to claim that VAT. And those are the things that will generate marks for you. And you can be sure that there's no one who can set an exam without actually putting in items of that nature. So there are items where you see that you have to calculate input VAT, but your comment is going to be not claimable or not creditable. I have incurred VAT. This item is standard rated and therefore they are going to charge me VAT, but I cannot claim that VAT. We call it non-creditable input VAT. So whenever you see purchases, you look out for these items. And when you see them, calculate the VAT, but don't include it in your input VAT because it is non-creditable. It is non-claimable. The law has said, yes, you have incurred it, but you cannot claim it. So these are the items that you're going to get. Number one, we call it passenger automobile. The repair and maintenance of that mobile, including the spare parts. What is a passenger mobile? The sitting vehicle. Whether it is a bus, whether it is a coaster, whether it is a minibus, whether it is a Pajero, as long as it is a sitting vehicle, it is called a passenger automobile. When you're purchasing it, they charge you VAT, but you cannot claim that VAT. And therefore, you calculate the VAT, but don't include it in your input VAT. And the comment will be non-creditable. The only exception to that general rule is when this person is dealing in buying and selling of those vehicles or is a tour operator. But otherwise, you don't claim input tax on passenger automobiles. Number two is entertainment. Is entertainment. And the definition of entertainment. The definition of entertainment, I want to show you the definition of entertainment so that you're able to appreciate it. Just a second. So, definition of entertainment includes provision of meals, recreation, and I'll give examples. Refreshments, drinks, invoice, there's going to be VAT. But you as a company, you can't claim that VAT because it is on entertainment. It is different from Serena, when Serena is the one incurring VAT on the items that it is going to sell to us. Because we expect that Serena is going to incur costs on food, is going to incur costs on other items that we are going to consume and pay for a price. So Serena will claim input VAT. But for me, who has gone to Serena and it has charged me input VAT, we call that entertainment and you cannot claim it. The law says that input VAT is not claimable. So that is entertainment. Number three is on telephone. Now, VAT on telephone is unique. For it, you don't disallow the whole of it. You only disallow 10%, meaning you can only claim 90%. So whenever you have a telephone bill, you first calculate VAT in that telephone bill. After calculating the VAT in that telephone bill, apply 90%. It's 90% that you can claim. The 10% you can't claim it. The other item, I think basically those are the major items that you need to deal with. The other item that I want you to actually appreciate is what you call VAT on imported services. With VAT on imported services, please do not mix it with your answer. I repeat, if they tell you that you actually bought services from a foreign supplier, what the examiner is testing you on is testing you on VAT on imported services. VAT on imported services is calculated separately, where you get 18% and apply it on the invoice value of that supplier, foreign supplier, and you do not less it with anything. So in a maximum situation, that VAT on imported services will be calculated separately and then declared separated. Don't mix it with your main calculation. And an imported service simply means a service that has been provided by a foreign supplier. It's something that you need to remember. Another free mark that comes in VAT is on salaries and wages. Whenever you see salaries and wages, the only comment the examiner expects from you is out of scope. Salaries and wages are out of scope. So do not attach any value to it, but make sure you indicate that salaries and wages are out of scope. I have already talked about when VAT is inclusive. I've already talked about when VAT is exclusive. I now find I want to talk about VAT withholding. VAT withholding. If you're doing an exam and you see an element of VAT withholding, this is how you're going to deal with it. If they tell you that you withheld from the other party, that you're a designated withholding agent, and they tell you who you're supposed to withhold from, how do you withhold? You calculate 6% of the amount exclusive of VAT. For you to calculate VAT withholding, it is 6% of the amount exclusive of VAT. An example, I am XYZ supermarket. I am a designated withholding agent. ABC is supplying to me goods worth 100,000, for example. And he adds on VAT of 18%. So he gives me an invoice of 118,000, not so. When I am paying him because I'm a withholding agent, I am going to first calculate 6% of the value exclusive of VAT, which is how much? Which is 100, not so. Because 118 is inclusive of VAT. So I must first of all look for the amount exclusive of VAT before I apply the 6%. So for me to calculate VAT withholding, I get 6% times the amount excluding VAT. That is how we calculate withholding VAT. And you will know that they want you to calculate withholding VAT if they tell you that you're withholding, the person you're calculating number for is a withholding agent, and then the other party is not exempt from withholding tax. I've already talked about. Now, last thing I want to talk about VAT is apportionment. Have you heard about apportionment? Definitely, yes. At this point, I'm not telling you something new. If you discover that in your schedule of sales, where you were calculating output VAT, you discover that you have a mixture of taxable sales and exempt sales. I repeat, if in your table, whether you made a mistake or not, but in your table you said I have exempt sales, it means indirectly you're saying I am going to apportion my input tax. I repeat this. If you are in your schedule of sales, you have both taxable and exempt sales. Automatically, the law requires you to apportion your input tax. How would we do that? Number one, for you to apportion your input tax, this is what you do. Remember, you will have your input tax, which you've already calculated, your output, your input VAT. But you're saying, because I am dealing in both taxable and exempt supplies, there is likely to be some input tax that I am not supposed to claim. Because the law says, if you're dealing in only exempt supplies, you can't claim input tax. If you're dealing in taxable supplies, claim your all input tax. But if you're dealing in both taxable and exempt, then apportion that input tax so that only input tax relating to taxable sales is the one that you are claiming. So I have calculated my input tax from my purchases and sales. Remember, I have already done the other nitty-gritties of removing passenger automobiles. I've already removed the entertainment. I've already reduced my telephone. Now I have my input tax. The next thing is to apportion that input tax so that I know the input tax takes my computation. How do I do it? I get that very input tax. I multiply by, I hope you can see, I multiply by a fraction of total taxable sales, and I want to emphasize using the exclusive amount over total sales. So let's do this. So I want you to understand this formula. Let me actually expand it. Remember, this formula only comes after you have already determined your input tax. But you're saying the law does not allow me to claim all this input tax because in my sales, I also sold some exempt items. So then we are asking, of this total input tax, how much should you qualify for? And you qualify to that input tax that is proportionate with the taxable sales. Taxable sales is a combination of standard rated sales plus zero rated sales, but at exclusive amount. So if your amounts were inclusive, you must first of all determine the exclusive amount before you use them on this formula. So you aggregate your standard rated sales at exclusive amount and also the zero rated sales. Of course, for them, they are always at exclusive amount. So you aggregate them, that gives you your total taxable sales. Then you have it as a fraction of total sales. Means total sales means standard rated plus zero rated plus exempt. Now, this ratio alone of taxable sales over total sales, in layman's language, it shows the percentage of taxable sales over your total sales. And therefore, that is the percentage that you apply on your input tax to get how much input tax you can be allowed. That is what you call apportionment. And this method is called the standard method. I am not going to go into the standard alternative method, but because in the exam, definitely, if you're going to do apportionment, you're going to use the standard method. But when do you know that you should apportion? You know if you go to your sales and discover that some of your sales have been named as exempt. The moment you have any exempt sales, then you must do this calculation to be able to know the input tax you're going to use in your calculation. And this that you have apportioned is what you take to your calculation of VAT. I am now going to receive questions on VAT, and then we'll be able to proceed. I told you in this class you come ready. We are going to conclude at 1, but I will have finished my part. Yes. Please go ahead and ask.
Yes, you said in computing input VAT, input VAT on imports is computed different. But then when at the point of getting input VAT payable claimable, do we also bring it along there?
Once you have actually had VAT on imported services, calculate it separately. Remember, it does not have input VAT, it only has output VAT. And after you have calculated your total, your net VAT payable, that's when you can add your VAT on imported services to get to the total that you have to pay to URA. Okay. Yes. Pardon? Deemed VAT is ideally standard rated, because the reason why we call it deemed VAT is because it is standard rated, but the law said the other party who was supposed to give you output VAT is going to be assumed to have given it to you, but it does not change the character in terms of categorization. So deemed VAT are actually standard rated sales, only that in terms of payment of VAT, the other party does not pay VAT because the law has assumed that he actually paid VAT. That's why it's called deemed paid VAT. Yeah. So you include it in your standard, your taxable supplies. Yeah. Yes. How do you calculate the exclusive amount? Now, if you are given the inclusive amount, how would you get the exclusive amount? Because when they give you inclusive amount, it means it has two components. It has the exclusive amount and VAT. So how do you get the exclusive amount in an amount that is inclusive? You get the amount that is inclusive of VAT multiplied by 100 out of 118. When you do what? No, if you're going to actually, if the sales were inclusive, you first do the sales that were standard rated because they are the ones that are inclusive. First turn them into exclusive. So aggregate all that were standard rated but inclusive and then multiply by 100 over 118 to make it exclusive before you add it to zero rated. Because the zero rated has no VAT. If you first combine both of them at once, then you will actually be thinking that also zero rated had VAT. Yet it does not have any VAT. Okay. Quickly. I want you to breathe in and breathe out. Customs is very short. A question? Yes. And ask loudly. For what? For the total sales. Yes. In here, we said for the total sales, it is standard rated plus zero rated plus exempt. And all those amounts must be exclusive. Every time you're using this formula, make sure it is exclusive. Every time you want to calculate VAT withholding, make sure you're calculating it on exclusive amount. Never apply anything on inclusive amount. Okay. Do you want stand up and stretch? Stand up and stretch so that you consume customs when you're fresh. If you want to run and have a short call, run and come and. Some people are saying when you're teaching, you don't give us space to even go and run and don't suit on yourselves. Please. So quickly, we come back at 35 minutes. As we are coming back here at 35 minutes past midday, just use 3 minutes to stretch.
Excuse me, Council.
We are in a break just of 3 minutes, brother.
Okay then.
So shall we come back? We don't have a lot of time. Okay, so.
Excuse me,
please, by the way, before you ask the questions, there's something that I forgot on VAT. If they also tell you that you did not get an invoice, then you cannot claim input VAT. Any input VAT that is incurred without the support of an invoice is IFRS. You can't claim that input VAT. So if someone charged you VAT, but they don't give you an invoice, you know that you have lost that VAT. Please ask your question before we proceed.
Okay, thank you, Council. Is there any way,
I said VAT on imported services simply means that you've received services, but the service provider is a foreigner. And therefore, the law requires you, the recipient of the service, to compute 18% of the value of the invoice value and declare that 18% to URA without reducing it with anything. And therefore, ideally, you don't include it in your computation of output minus input. You calculate it separately because for it does not have any input. And then after you have done all your other calculation, if you want to know your total tax liability, you get the other liability plus the VAT on imported services. Okay, so guys, like I said, the questions are very many, but I am going to give you my contact after this session, and we can continue discussing. At least I am. Yes.
Is there any trick on how we can identify these exempt items, because there are very many?
Someone is asking, is there any way we can identify these exempt items? Largely speaking, if you see an item that is related to the health sector, you see an item that is related to education sector, you see an item that is related to agriculture sector, and it is a service, for example, then you know such services under those sectors are actually exempt. So the services under the agriculture sector, the services under the health sector, the services under the education sector, and the services under the insurance sector, those are largely exempt. And you'll be able to actually check them when you go through the list. Okay, so let's come to customs. Quickly, I am left with only 2 parts to conclude this. And I want to use the next 20 minutes because they are very small. Customs, what do you need under customs? What is the examiner going to ask you about customs? The examiner is going to be asking you to determine the customs taxes or the taxes payable at importation. The examiner is going to be asking you to determine the customs taxes or the taxes payable at importation. These are the relevant taxes. Number 1 is import duty. Number 2 is excise duty. Number 3 is VAT. Number 4 is withholding tax. Number 5 is infrastructure levy. Number 6 is environmental levy. The question is, do all these apply all the time? The answer is no, and I'm going to tell you why. So when you're doing any number on customs, the first thing you're going to do is to determine what you call the customs value. The other name of customs value is CIF. So the question is, how do you determine the customs value? Because when you get the customs value wrong, I repeat this, when you get the customs value wrong, the other answers will be wrong. because the other taxes are based on the customs value. So I want you to listen to what I'm going to emphasize. In some instances, you're either going to be importing, or this person is going to be importing a motor vehicle, or is going to be importing other items, clothes, equipment, machinery, etc., etc. For motor vehicles, there is a likelihood that they are going to give you a URA predetermined customs value. So when they give you the URA predetermined customs value, please don't look for your own customs value. Start from there and calculate the taxes. If they have not given you the customs value, then you must look for the customs value. And largely speaking, ladies and gentlemen, customs value is the cost plus insurance plus freight. The only question you have to ask yourself, what should be included in the cost? Because the only confusing part is the cost. Because insurance is going to be clear, freight is going to be clear. That is when you're going to use the sea, if you're going to use the ship. If you're going to use air transport, that CIF changes into only CI. We only get the customs value as the cost and insurance. When you're using the freight, when you're using a freight, when you're using the plane, we do not include the freight charges when we are computing the customs value. So, how do we compute the customs value? Because we said the customs value is the starting point. Because once I have the customs value, then I can be able to compute the other taxes. It will be so easy to compute the other taxes. Now, when we are looking at customs value, we said it is the cost of the goods plus insurance plus freight. But it is not as simple as that. So we must know what are the things that I'm going to include in cost, what are the things that must be excluded from cost. The first formula is that all costs that you incur from the country of export to the country of import. Assume, for example, I am importing something from China. All the costs that I incur up to the port, because Uganda does not have a port, it means our entry port is Mombasa. So all the costs that I incur from China to Mombasa are part of the customs value. And the costs that I incur to Mombasa and coming to Kampala, for example, all those costs are not part of the customs value. So the hint is, and this is how you're going to get it right. If you see any cost that is incurred at Mombasa, or any cost that is incurred after Mombasa, please don't include it in your customs value. But any other cost from wherever you are importing something up to the point of Mombasa is part of the customs value. Now I'll give you a scenario. I am in China, I am importing an equipment. What I do, I go to the factory. When I go to the factory, there is a price that I'm going to pay to the factory owner, the manufacturer of the equipment. It is called the ex-factory price, or simply call it price. If that person gives me any discount, any trade discount, the trade discount must be removed from that purchase price, from that ex-factory price. So a discount is not part of the customs value as a starting point. So whenever you see a discount, please remove it from the purchase price. Now, after this guy has given me the equipment from the factory, what am I going to incur? One, I must load it on, for example, a truck, their loading costs. I must take it to the port of China and offload it because I want to put it on the ship. Those are offloading costs. If I have to incur any storage costs while I'm in China, those are part of the customs value. If I have to incur any transport costs in China, those are part of the customs value. When I get to the ship, what do? I have to pay for freight charges, transport on the ship. But I must also pay for insurance until these items dock at Mombasa Airport. The moment they dock at Mombasa Airport, every other cost starting from Mombasa is not part of the customs value. So I'm going to show you the list of the items that you're going to find in that number, so that you're able to know that I should include this or I should not include it. And once you get that right, it will be easier for you to actually get it right. Finally. Now I'm going to first tell you what costs you must include in, and then once we have determined the customs value, then we'll see how to calculate the taxes. So what are those costs? These are the costs, if I can expand them. Number one, cost of the goods free on board a transport vessel in the country of export. That is the ex-factory price. And I said the only thing that you can reduce the factory price or the purchase price is the discount. Please, every time you have a discount, first knock it off. Freight charges up to the place of importation, for example, up to Mombasa. Loading, unloading, and handling charges associated with transport of goods when you're the other side. The cost of insurance, pre-shipment inspection, if you have to incur any pre-shipment inspection, commissions and brokerage except buying commission. Cost of containers, sometimes they tell you have to actually buy the container and packaging materials. Packaging costs, assets, royalties and license fees. Sometimes you find the manufacturer there says, we are not manufacturing for Uganda. If you're going to buy any equipment from here to Uganda, you also pay on top of the cost, you also pay some royalties. So royalties become part of the customs value. Subsequent proceeds, that's not very common. Transportation costs and insurance costs up to the point of Mombasa. Now, I am indicating that while for goods imported using air transport, the customs value is composed of the price for the goods and the cost of insurance. Freight is not included. I had already said that. Now, costs excluded from customs value. This is where the examiner keeps on picking these costs. Transport from Mombasa to Kampala, insurance from Mombasa to Kampala, clearing charges, storage costs at Mombasa. I have also, just a second, I think I have a list. Okay, I want you to see this list. So I am picking the costs that you would ideally be including in your customs value. And I have also picked the item that you cannot include in your customs value. We say the costs, that is the purchase price, less any trade discounts, any pre-inspection fees, insurance on board, that is sea insurance on air. Now, if you pay any insurance inland, for example, if you have to pay insurance from Mombasa to Kampala, that can't be part of the customs value, because we say any cost that you incur when these items are already at Mombasa and any subsequent costs inland means now you have started entering Uganda, they cannot be part of the customs value. Freight, that is transport to the port of entry, e.g. Mombasa, is included. Packaging, we said, is included, or cost of the container. Shipping fees included. Port handling services charges, while you're the other side. Now, the port handling services or charges the other side are included in the customs value. But the charges here at Mombasa are not part of the customs value, because we said any costs at Mombasa and coming through are not part of the customs value. Port handling services, stock charges at Mombasa excluded. Training costs. Now, sometimes you buy an equipment where you find the seller or the manufacturer is the one that is going to train you on how to use that equipment. That training by the manufacturer or by the seller becomes part of the customs value. I think we should have seen them in different numbers. Installation fees excluded. Why? Because installation is done when you're already in Kampala, for example. Transport to the port included. If you're coming, for example, from Mombasa to the port, included. Inland transportation, for example, things have already moved, have already reached Mombasa, and then you have to incur costs from Mombasa to Kampala to Maraba to where, that is excluded. Air transport, we said air freight is excluded. Royalty is included. Storage charges in China included, but the storage charges in Mombasa excluded. Clearing charges excluded, but because that is happening at Mombasa. Any loan arrangement fees excluded because that is not part of the deal. Demurrage or demurrage charges excluded. Now, the reason why I picked these examples is because I am picking them from your exam questions so that you are able to see which costs must be excluded. But the formula remains simple. Any costs that you incur after these items have reached Mombasa is not part of the customs value. Now, if you aggregate all the costs that must be included in, you get the customs value. And then once you get the customs value, we start calculating the taxes. This is how we calculate the taxes. I am assuming that I have my customs value, the CIF. How did I get it? I aggregated all the costs from the country where I imported up to the point of entry, which is Mombasa. I now have the customs value. I am now starting to calculate the taxes. Tax number one is import duty. Now, import duty, by all standards, it is at 25% for finished goods. However, if the examiner tells you that these are raw materials, import duty is going to be at 0%. If he tells you that these are semi-finished goods, it is going to be at 10%. And then we have also items that we call sensitive items, and the examiner is going to give you the percentage. The advantage is that the examiner is going to give you the percentage of import duty. If he's silent, then you assume that import duty is at 25%, because the assumption is all the items that we are importing are finished products. So assume that import duty is 25% until the examiner tells you otherwise. And what is the otherwise? Is when he tells you that the items you're importing are raw materials. Already you know that that will be 0% or semi-finished at 10%. And if he says that this item is a sensitive item, he gives you the import rate, because usually the import rate will be more than 25%. I have picked the sensitive items and their rates that you could actually relate to. But don't panic with these rates. The examiner is going to give you the rates on import duty if it is a sensitive item. For example, milk and cream attracts 60% import duty. Wheat grain 35%, wheat flour 60%, rice 30%, maize 50%, sugar 100%. These are sensitive items. So if they tell you that this item is a sensitive item, you do not cram with the 25%, you go with the rate that they have given you for purposes of calculating import duty. How do you calculate import duty? The rate, import rate, times the customs value. So that is our item number one. So my import duty is item number one, and I'm going to get my import duty by getting the import duty rate times the customs value. The next item on taxes is excise duty. Ladies and gentlemen, excise duty is not applicable everywhere. And therefore, most of the numbers that you're going to do, you will discover that there is no excise duty. But exceptionally, if they give you an item and the examiner says that this item attracts excise duty, he will give you the percentage to apply. The question is, how do you apply it? When we are calculating excise duty, we first combine two things. We first combine the customs value plus the import duty that we just calculated. And that total is what we apply on the excise duty rate. So if I have the excise duty rate, I multiply it with the total of customs value plus the import duty. And any item that attracts excise duty, please calculate excise duty before you calculate VAT. Please calculate excise duty before you apply VAT. Now, the next item would be VAT. The next item would be VAT. How do I calculate VAT? When I have an item that has excise duty, I am going to combine now three things. I am going to get the customs value plus import duty plus excise duty. The total of that is where I apply the 18%. I repeat, when you're given both VAT and excise duty, you first calculate excise duty before you calculate VAT. Because in the VAT calculation, you need a component of excise duty. So VAT will be 18% of this amount. Customs value plus import duty plus excise duty. Once you're done with VAT and excise duty, the others are easy because the others you apply them directly on the customs value. It is only VAT and excise duty that have some level of compounding. Because we said for excise duty, you first compound customs value plus import duty. For VAT, you compound the three. Customs value plus import duty plus excise duty. It simply means that if the examiner does not tell you that this item has excise duty, you would jump from import duty and then calculate VAT. It means in the calculation of VAT, it will be a combination of customs value plus import duty. There you will not have any element of excise duty. The next item after VAT is withholding tax. Withholding tax is 6% of the customs value. So withholding tax, you apply it directly on the customs value. The next one is infrastructure levy. Infrastructure levy is 1.5% of the customs value. Ladies and gentlemen, whereas they can give you percentages of import duty, they are not going to give you the percentage of VAT, they are not going to give you the percentage of withholding tax, they are not going to give you the percentage of infrastructure levy. So you must know, you must go to the exam knowing them. VAT is 18%, withholding tax is 6%, infrastructure levy is 1.5%. That is on goods, equipment, normal goods. So the taxes that are applicable that you're going to aggregate is import duty plus excise duty if it is there, plus VAT, plus withholding tax, plus infrastructure levy. Those are the five that we aggregate to get the total tax payable on goods or equipment. When it comes to motor vehicle does not have excise duty, but it has environmental levy. So for it, you will add another tax called environmental levy. And environmental levy, the examiner is going to give you the percentage that is applicable. Once he gives you the percentage of environmental levy, please apply it directly on the customs value. So if it is a motor vehicle, it means the total taxes will be import duty plus VAT plus withholding tax plus infrastructure levy plus environmental levy. And that will give you the total taxes at customs. When you are aggregating taxes, please do not aggregate in customs value. I have seen the students struggles and they have calculated everything right. And then when they are saying these are the total taxes, they also add customs value. Customs value is only for helping you calculate the taxes. But the taxes are import duty plus excise duty, if any, plus VAT, plus withholding tax, plus infrastructure levy. And if it is a motor vehicle, you add environmental levy. Your strength is about determining the customs value. Once you get the customs right, you'll have it right. Is there any question on customs before I actually get to my last part? I have about 20 minutes now as a bonus. Pardon? Environmental levy has different percentages depending on the age of the vehicle. That's why you have to wait for the examiner to give you the age of the vehicle. But as an example, these are the percentages that are applicable. If it is a passenger stroke saloon vehicle and it is below 9 years, you don't pay. Any vehicle that is below 9 years, you don't pay any environmental levy. But if it is a passenger or saloon vehicle and it is between 9 and 15 years, you pay 50% of the CIF, of the customs value. So you get 50% times the customs value. And if it is above 15 years, definitely it is not allowed in Uganda. For goods vehicles of gross vehicle weight less than 4,000 kilograms, if it is below 9 years, no environmental levy. If it is between 9 and 15, 20%. And if it is above 15, it's not allowed in Uganda. Goods vehicles of gross weight more than 4,000 kilograms or more. Below 9 years, no environmental levy. Between 9 and 15, 20%. And you can also be allowed to bring an old vehicle in here. Motorcycles, 20% if they are between 9 and 15. So usually, we charge environmental levy to vehicles that are above 9 years but below 15 years. If anything is above 15 years, we don't even allow it here in Uganda. But don't worry about these rates. When the examiner is asking about environmental levy, he's also going to give you the rates to apply for environmental levy. You're not going to cram those rates. But for the rates of VAT, know that it is 6. For the rate of withholding tax, know that it is 6. VAT 18, withholding tax 6, infrastructure levy 1.5. Those are the ones that they are not going to give you. And they are not going to tell you whether you should calculate them or not. But you must remember to calculate them. If something is imported as a temporary import, we have things that we call temporary imports. They do not attract tax. Like these musicians, when they are coming, they come with their equipment. When we are clearing them, we clear them as imports, but they are called temporary imports. They do not attract tax. Yes. Now, that is not an academic question. That is a practical question, because each of the items that you're going to import, we have a database for those items, and we know we have the values for those items. That's why when you import something and you under-declare it, we are able to actually tell you the correct values, because we have all those items in the database, and we are able to actually understand what the values are. Like I've said, whenever you import something, it is not only you who has imported it. There are other people that have imported it, and we have cleared those items and established what value of customs value we can actually easily attribute to those items. That's why we have the evaluation methods. If you've gone through your literature, we have what we call the evaluation methods, and we take step by step. If the transaction price fails, we look at identical items, we look at similar items, and then we can use different methods to actually determine the value to attach on those items. And you have reminded me, those evaluation methods are very important for you. Okay, I am now going to attend to only 2 questions on customs, and then I can conclude with my partnership and we go home. And then I can only pray for you to all pass. Because, yes.
My first question is to pardon me on the order of computing those taxes.
The what? The order?
Yes.
The order of computing those taxes, we start with import duty. And for you to get import duty, you get import duty rate times the customs value. The second one to compute is excise duty if it is available. And I told you excise duty is not available all the time. But in case it is available, to get the excise duty, you get the excise duty rate times a combination of customs value plus import duty. The next one in the queue is VAT, in that order. And to get VAT, you get a combination of customs value plus import duty plus excise duty, and then apply your 18%. The next one is withholding tax. Withholding tax is 6% applied directly to the customs value. The next one is infrastructure levy, 1.5 applied directly to the customs value. And if you have a motor vehicle, you add one other one called the environmental levy, and the percentage will be given to you because it is dependent on the number of years the vehicle has. I hope we are together. Ladies and gentlemen, allow me now switch to partnership.
Question, sir.
Yes?
I'm inquiring about pre-inspection costs because I'm looking in the question for August 2024.
I'm not going to the specific questions. I said pre-shipment inspection is part of the customs value.
For this question, in the answer, the inspection costs were not considered.
Then it is wrong. There are answers that are wrong, but pre-inspection costs are part of the customs value, unless the inspection is done in Uganda. If it is done the other side, then the pre-inspection cost is part of the customs value.
Thank you.
You're welcome. Okay, so breathe for the last time and we attack the last number and we close it. Tell me when you're done with breathing. The partnership is easy because all that I said when I was doing number 1 is the same thing you do with the partnership. And then I will be emphasizing the exceptions. Are we together? So the knowledge that I emphasized in number 1 is the same knowledge you use when you're doing partnership, but I'm now going to tell you the specific additions in partnership numbers. So anyone who does number 1, and there is also a number on partnership, don't miss the number on partnership. Because if you have chosen number 1 and say, this one I know it, anyway, you have a choice on number 1, it's comparison. But if you know that you have mastered number 1, then don't fear a number on partnership, because you'll only be adding a few concepts on the partnership to get it right. So let's see what are those additional items that you have to deal with in a partnership number. There are about 5 steps that you take successfully do a partnership number. What are those steps? Step number 1 is to determine the chargeable income. So if you're doing a partnership number, make sure that you have gone through these steps that I'm going to talk about. If you don't go through them, then you know you've not gotten it right. So step number 1 is you must determine the chargeable income of the partnership. Remember, guys, first remember this concept. With the number on partnership, you have 2 parties. The partnership as the firm, and then the partners. Now, the partnership does not pay tax It is the partners that pay tax. So for the partnership, you're going to do two things in the partnership calculation. You're going to determine the chargeable income as step number 1. And then step number 2, you determine the distributable profit or loss. That is all you do with the partnership. Once you're done with that, it means you switch to the partners now. So I repeat the steps. Step number 1, determine the partnership's chargeable income. Step number 2, determine the distributable profits or losses. Step number 3, determine each partner's chargeable income. Step number 4, determine each partner's tax liability. I am repeating them. Step number 1, determine the partnership's chargeable income. Step number 2, determine the partnership's distributable profits or loss. Once you have determined that, get out of the partnership, go to the partners now. With the partners, why are you there? It's because you want to determine each partner's chargeable income. And after getting each partner's chargeable income, you determine the tax liability payable by each partner. So we are going to go through those steps and see how do I move from step 1 to step 2 to step 3 and step 4. And then I will indicate to you the things that make you pass the partnership number. So the way we got number 1, we said if I am looking at a tax computation, I am going to put a heading. And this time the heading will be that partnership name and tax computation for the year ended this, or chargeable income, computation of chargeable income and distributable profits for the year ended this. Just like we started the other one, we also start with the profit or loss before tax. And then you also come back and add back non-allowable deductions. The same non-allowable deductions that you added the other side are the same non-allowable deductions you add back here. However, we have specific things that are non-allowable in a partnership computation. And those are the ones that I want you to master now. Because the others, it is assumed the others you already know. So the others bring them. But on top of those that you have brought, these are the specific items that you will add back when you see them. So when I am doing a partnership number, I first focus on those specific ones. What are those things that I must add back when I see? Number 1, of course, the depreciation is normal. But I am now looking at the specific things that are specific partnership. Number 1, interest on capital. They will tell you the partners are paid interest on their capital contribution. That interest is a non-allowable deduction. Number 2, partners' salaries. If a partner is paid a salary, that salary is a non-allowable deduction. Please be careful, because partnerships pay other salaries to other employees. What we are disallowing is only the salary to the partners. So salaries to the partners is a non-allowable deduction. Number 4, partners' drawings. If the partnership spends on the partner, that is called a drawing, and we shall add it back. So 3 things, remember them. And whenever you see them, please add them back. Number 1, interest on capital. Number 2, partners' salaries. Number 3, partners' drawings or private expenses. The reason why we add them back is because partners form partnerships with a view of making a profit so that they can be able to share the profits. So any appropriation before they determine the profits is not a legitimate appropriation. They are not supposed to share anything until they have determined the profit. That's why when they pay them interest on capital, they shouldn't pay them interest on capital because they have brought the capital so that they can make a profit and share that profit. So they cannot share, they cannot be paid interest on that capital. They cannot be paid the salary because for them their role is to share the profit. So you cannot be waiting to share the profit and you also want to be paid a salary. When you actually withdraw money from the partnership, it is a drawing, and we know that drawings are not expenses. That's why we are adding them back. So when you get into the exam, please look out for these additional items that are specific to the partnership and add them back. And any other non-allowable deductions as already discussed in the other number. So if you see any other non-allowable deductions, add them back. The next thing is less allowables. The same way we calculated the allowables the other side. Prince, also partnerships have capital deductions, also partnerships. If it is exempt income, we remove it. If it is rental income, we also remove it. The same way we actually did in number 1. Now, after that, we said you get chargeable income. The way we did in the other number, get your chargeable income, you have specified step number 1. It means what is only unique in that step number 1 are the things that we added back. The other things are the same. Now, after getting chargeable income, it means you have gotten the true position of the partnership. But again, you ask yourself, is this money that I am calling chargeable income still available for distribution? The answer is no, because it has already been, part of it has already been distributed. So you draw what you call an appropriations account. This is what we call the distributable profit now. So how do you get the distributable profit from chargeable income? The things that you had added back as things that entered the pockets of the partnership, you now subtract them because they have already taken them out. That's why from the chargeable income, things that you had added back, you now come and subtract them because you're now looking at the profit that is distributable. You were adding them back because you wanted to determine the true picture of the chargeable income if these things had not happened. But the truth is that they happened. And therefore, in accounting, we say you are going to do an appropriations account. An appropriations account is that you debit the partnership and credit the respective partners' accounts. How do I do it? I remove an item in from the partnership, I take it to the partner's individual account. So what do I do? After getting chargeable income, the things that we had added back, what did we add back that were specific to the partnership? We added back interest on capital. So this time I subtracted. We added back partner salaries. I subtracted. We added back drawings. I subtracted. Now I'll be getting what we call distributable profits as your step number 2. So step number 2 is easy because whatever you had added back relating to the partners, you're now subtracting it. And in accounting, we are saying you are debiting the partnership account and you're going to credit the partner's account. So whatever we are removing here, for example, if I say interest on capital, I am going to go to the specific partner's accounts. Whoever received the interest, I put it in his account. When I say partner's salaries, whoever received the salary, I put it in his account. When we say drawings, whoever actually made the drawing, I put it in his account. Now, this that I have gotten as a distributable profit, that line, if I can expand it, I can expand this line, called distributable profits. It can also be a loss because a partnership can actually make a loss. But whenever it makes a loss or a profit, that profit or loss must be distributed among the partners in their profit sharing ratio. That brings me one of the key concepts of taxation of partnerships. Partnerships do not have carry forward losses. Just like the other number had carry forward losses. So do not put a carry forward loss in a partnership. Why? Because each year they share that loss among the partners. So the partnership has nothing to carry forward. That's why a partnership does not have a carry forward loss. So in the computation of chargeable income, please do not bring in an element of carry forward loss when you're still in the partnership. Because anything that is a result here, if it was a loss, it is going to be shared. If it is a profit, it's also going to be shared. That's why this figure now called distributable profit is what we are going to share among the partners using the profit sharing ratios. So I get now to draw my partners now. I have partner A, for example, partner B, and partner C. Now, what am I going to put in the specific partners accounts? I want you to see the specific partners accounts. Assume I have partner A, partner B, and partner C. The first thing they are going to share in their respective accounts is that share of the distributable profits or loss. So I come on this profit or loss, the distributable profit or loss. And for each partner, if one partner has 3, for example, if I have 3 to 2 to 1, those are sharing ratios. It means the one of 3, what is the total of 3 to 2 to 1? What is that? 6. It means partner 1 will be 3 out of 6 times that amount. Partner 2 will be 2 out of 6 times that amount. Partner 3 will be 1 out of 6 times that amount. What am I sharing? I am sharing the distributable profit. Where am I taking? I am taking it to the share of profit stroke loss, because they can share a profit or a loss. That is line number 1 in each partner's accounts. The second line, I ask, is there any partner who received the salary? Those salaries that we are adding back, I am now bringing them to the partner's salaries. Assume each partner received the salary, I put it in his account. Assume each partner received interest on capital, I put his portion in his account, how much capital interest on capital you received. Assume there is a partner who received, because the partner can be allowed to give a loan. On top of your contribution, you can also give a loan to the partnership. Now, please pay attention. Interest on loans given by partners, you don't add them back because those are legitimate. On top of my contribution, I also added in a loan. So the interest on loan is not to be added back. You only add back the interest on capital. But when it comes to their individual accounts, interest on loans form part of their accounts. Any partner that gave out a loan and he was paid interest, the partnership claims an expense and this guy must report the income. That's why we are bringing it in his income. Remember, guys, the reason why we are creating these please mute your microphone. The reason why we are creating these partnership accounts, rather partners accounts, is that we want to determine each partner's income. How much did you earn as a partner? Because you're not going to earn the same things. There are partners that are going to earn interest. There are those who are not going to earn it. There are those who are going to earn salary. There are those who are not going to earn it. There are those who even earn other sources of income outside the partnership. All that must be brought in their accounts. So, interest on share of profits, we saw where it is coming from. Salaries, these are partners that have received salary. Interest on capital, bring their interest on capital. Anyone who has received a loan, interest on loan, bring it. Anyone who has made a drawing, bring that money. Then there is this item called income from other sources. We are now saying, remember, this partner is earning any other income outside the partnership. that income that you're earning outside the partnership is also part of the income that you're going to tax. And it could be income that you also earn from outside sources. Some partners would also have outside sources. So they bring it on board. We also put it there. Now, any interest on drawings is the next phase, because when you get a drawing from the partnership charges you interest. So interest on drawings for you, it is the cost to you. And that's why we are removing it there. Now, I want you to see, when I get the share of profit or loss, I add the salary that you earned. I add interest on capital that you earned. I add any interest on loans that you earned. I add any drawings that you picked. And I add any other income notes from any other source. And I subtract interest on drawings. Then I'm able to get your chargeable income as an individual pattern. So each individual pattern has his own chargeable income. Now, when I get the individual chargeable income, please pay attention to this now. When I get the individual chargeable income, that's when I remove any carry forward loss of any pattern who had sustained loss in the previous year. Because we are doing calculations now for each of the partners. It is possible that one of the partners is like to have a loss. When you get a loss this year, it means for you have an opportunity to carry forward a loss next year. So a partner can have a carry forward loss, but a partnership cannot have a carry forward loss. Are we together? So at this point, you look for any partner who has any carry forward loss. It's when you bring it on top. And then you have your adjusted chargeable income. When you get your adjusted chargeable income, it is time to go where? To the tables. Not so? You go to the tables of individual income tax rates, the tables you have in your question paper. And pick for each individual pattern. You look at their adjusted chargeable income, ask where does it fall. Pick their tax, compute their tax, bring it here as tax payable. After tax payable, like we did the other side, what did you remove from tax payable? Any credits. Now, the individuals will have all these credits also. Because if an individual collected income outside Uganda, he would also like it to have foreign tax credit. If this individual also had paid provisional tax, he will also have a credit for provisional tax. Now, I want you to pay attention to withholding tax. Withholding tax would have been suffered by the partnership. But does the partnership have an opportunity to claim it? No. So who claims it? The individual partners. How do they share it? They share it using the profit sharing ratios. So if they tell you the partnership has withholding tax credit, you're going to share it among the partners in their profit sharing ratios. Then you also remember there could be partners who earn salaries, and when they earn salaries, they charge them pay as you earn. At this time, pay as you earn becomes part of their credit because you're bringing their salary into their chargeable income. And therefore, the pay as you earn that they were charged becomes part of their credit. And then you're able to determine their net tax payable. That is the story of the partnership. Yes. Yes. Pardon? Yes, when you're bringing the salary, you're bringing it as gross. Because when you're paying you, they are paying you salary in gross, so you bring it as gross. If they tell you that these salaries, because the salaries were even claimed for income tax purposes that you're going to find in the statement of profit or loss is always going to be gross. So you're also bringing it as gross. And therefore, you're giving him a credit for the pay that he has already suffered. Any question? Yes. Pardon? How do we treat the dividends? The question is, now the principle of, you remember the principle of final tax? Withholding tax as a final tax? Applies directly on the partnership as if they were individuals. Because remember, the partnership are the individuals, not so? So a partnership is treated as though they are individuals. So whatever we said is final in the hands of the individual. So if the partnership had earned dividends, it means it has already suffered withholding tax as a final tax. If it has earned interest on treasury bills, it is final. If it has had interest on fixed deposits, it is final, because we are dealing with individuals. So whatever the concept of final tax will also apply on the partnership. Any other question?
Council, excuse me.
Yes. I need only 2 questions to close this. I want to only use 2 minutes to comment on rental tax and I close. Yes.
Yes, Council. My question is on
just the question in the physical class. Let me first attend to the physical class and then I come to the online class. Yes.
Yes, my question regarding this is when these partners earn professional fees. Professional fees,
okay.
For example, consultancy. How do you treat
I am
that?
going to answer both questions. There's a question online and there's a question on the physical class. I'm going to answer both of them at the same time. So I'm going to first answer the one on the physical class. The one on the physical class is asking, how do you determine the profit sharing ratios if they have not given them to you? If they don't give you profit sharing ratios, you look at their capital contribution, and their capital contribution will determine their profit sharing ratios. The one online is asking, please repeat your question. I've remembered. Yes. On professional fees. He said, yes, if the partners also earn other incomes in terms of professional fees, we said any other income that you earn as a partner, we bring it as other income because we are taxing you on all your incomes, more and over and above what you earn from the partnership. So if a partner has earned any other income outside the partnership, it is also going to be brought. That's why I have this line of other. Did you see this line? Other sources, income from other sources. That's where you bring your professional fees as well. Okay, any other question here?
Council, another question.
You bring the professional fees as growth, and then the withholding tax is allowed as a credit. Yes.
This question is regarding with capital gains tax.
Like it is regarding capital gains tax.
When we are having a short-term resident.
Aren't you mixing two things?
Sir? No. This is a different issue.
That's what I'm saying. Can we talk about partnership for now? And if you have any matter outside this, then we can offline it.
All right.
Because I am running out of time. I want to conclude what I had prepared to conclude. So allow me in the next 5 minutes, I talk about rental tax and we close this. Allowed? Okay. So rental tax. You're likely to get a question on rental tax in 3 categories. Rental tax earned by an individual, rental tax earned by, rather rental income earned by an individual, rental income earned by a company, or rental income earned by a partnership. How do we tax them? If it is an individual, you take only 3 steps. If it is an individual, you only take 3 steps and you'll have the tax. Step number 1, aggregate all the rental income that this person has earned in the whole year. So you look at the number of tenants you have times how much they are paying you times 12 months. So you aggregate all the gross rental income. Whatever you have grossed, remove 2,820,000. Whatever remains, apply 12%, and that will be rental tax. I repeat, if it is an individual, gets the total rental income for the whole year, what we call gross rental income. Remove the threshold that is allowed. The threshold that is allowed is only 2,820,000. What remains as chargeable income, apply 12%, and that will be the rental tax of an individual. If it is a partnership, get the gross rental income, divide it among the partners using their profit sharing ratios. And then for each individual, give them their threshold and then tax them at 12%. So the partnership is treated as the way we treat individuals. The only step you have to take is to make sure that whatever income has been earned by the partnership is shared among the individual partners in their profit sharing ratios, and then treat each individual as an individual taxpayer for rental tax purposes by giving them the threshold of 2,820,000, and then the balance apply 12%. When it is a company, you do some little more work. For a company, you're going to get the gross rental income. You first remove what you call allowable deductions related to rental income. However, the expenses that you're going to remove should never exceed 50% of the gross rental income. So if I have incurred more than 50% of the gross rental income as my expenses, what will be the cap of my expenses? It is only going to be 50% of the gross rental income. In other words, never deduct any expenses beyond 50% of the gross rental income. So if they have given you a list of the expenses related to rental income, you first get the total of those expenses. Then also calculate 50% of the gross rental income. Compare the two and take the lower of the two. Take the lower of the two as the allowable deductions. And once you get the gross income minus allowable deductions, you get chargeable income, apply 30%. Then you'll be having your rental tax for a company. The difference between a company and an individual is that a company is taxed at 30%, whereas an individual is taxed at 20%. A company is allowed the deductions, whereas an individual is not allowed deduction, but rather allowed the threshold. As simple as that. What is only left of me is attend to only 3 questions, and then I will pray for you and you go for the exam. Please, 3 questions if any, and if they are not there, then I will be closing the session. Any questions? I wish I could do more for you, but the time is limited and you're also up for the exam. But I am very sure anyone who picks what we have discussed today, you cannot, and I confirm you cannot try to get 50%, unless really God has given up on it. Please ask your question and then we close this.
Council, my question is that.
Pardon?
My question is that when we are given in terms of computation of capital gains tax, and we are given the cost of computation of capital gains tax, we are given the cost of the building. Let me assume that that building was purchased last year. It has been in presence for 1 year.
Yes.
Then when we have to first calculate industrial building on it.
Yes.
But when this person is a short-term resident of Uganda, how do we conduct that exercise? What rate are we supposed to?
We don't talk about short-term residents in capital gains. We only talk about short-term residents if we are looking at employment income. That is when it is relevant. It is not relevant. Short-term residents in capital gains is not relevant.
Okay, sir.
Yes.
So okay. We shall just only consider flat rate of 15% withholding.
The 15% on withholding. If you have any transactions, if you make any payments to non-residents, in terms of rent, in terms of interest, in terms of dividends, in terms of professional fees, in terms of management fees, then you apply 15% as withholding tax. And unless there is a double taxation agreement. And the impact of a double taxation agreement is to reduce the rates of withholding tax. Guys, we can't push it any longer. I have another
Cancel
class
your
at
number,
3, so I
please.
must close it here. Yes.
Cancel your number.
My number is, please ask any other questions through my number or on the groups where you are, and I'll be glad to answer them. But my number is 0776 64 66 06 0776 64 66 06. That is on WhatsApp. If you want me physically, I sit at the URA Tower, 8th floor. And you come and ask for the manager medium taxpayers office. If you want me on weekends, I am at Capital College at Bat Valley. If you are texting me, please make sure you WhatsApp me before midnight. After midnight, I don't respond to WhatsApp messages. I respond the next day. But I'm available after midnight. Guys, I wish you nothing but the very best. And may God give you the grace and the confidence to get it right first time. See you again.
Thank you, CPA Julius. Very, very rich. Okay.